Congress, a recession is possible. Steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Stocks and futures lose ground as growth fears occupy the forefront of investors' minds. Oil continues to slide. And Elon Musk says Tesla's new plants in Berlin and Austin, Texas are giant money furnaces, losing billions of dollars just days after clarifying to Bloomberg that he plans to cut 3.5% of Tesla's global workforce. Okay, let's check in on these markets then. The futures pointing to losses of around 0.6%. Jay Powell saying that yes, that path for a soft landing is very narrow indeed, and there is indeed the risk of a recession as the Fed pivots to try to tackle inflation. The FTSE 100 is currently just down 0.1%. We continue, of course, to keep an eye on what's happening within the energy space and basic resources. Xi Jinping of China, the president, of course, coming out and saying that they are still trying to hit those growth targets of about 5.5% for the year of 2022. Of course, most economists think that is going to be very challenging, if not impossible. Economists have downgraded, in fact, their forecast for growth out of China to 4.1%. The FTSE 100 now down 0.5%. The Spanish IBEX down 45 points. Over in Germany, you're seeing losses of 0.4%. You saw a big squeeze and a big move lower in the auto sector yesterday as well. Just keeping an eye out that in Germany. The CAC 40 over in France lower by 36 points. Let's switch it over and see how things are playing out then. Again, there was initially some modest optimism when Jay Powell started to speak, and then that turned lower again on the recession fears. The futures now stateside pointing to losses of 0.2%. We know that Treasuries has bid as well as part of this kind of modest risk-off mood that we're seeing in the session. Euro-dollar, keeping an eye on this. We've got PMI data out of a number of Eurozone countries throughout the next 2 hours, which will kind of flesh out the economic trajectory for the Eurozone. The implications, of course, for the single currency. 105 as Madame Lagarde commits to hikes in July and September, currently gaining 0.1%. Brent remains in focus, $110 a barrel, down 1.4%. We've seen volatility in the oil space. Are we starting to see signs of demand destruction? Iron ore, 113, higher by 5%. Linking that to what we heard from Xi Jinping, recommitting to those growth targets. Is it really sustainable, though? Okay, let's check in on some of the individual corporates that have taken our attention today. The Italian banking space and Banca Monte Paschi just up a little over 0.1%, planning to cut 4,000 jobs, and there's a recapitalization as well at play as they lay out their 2026 plan. Nordex winning a deal in Poland, currently unchanged. We'll check in back on this stock in the next few minutes later on in the show. Winning an order in Poland for 11 turbines, it seems. And Total, just bringing to your attention what's happening in the oil space again, continues to be relatively under pressure this week. We continue to watch, of course, what happens around Brent and WTI, currently down 0.8%, just one of the one of the oil majors we are focusing. Let's get out to Mark Cudmore, Bloomberg's M Live managing editor, for a look, a deeper dive into what's happening within the commodity space on these growth fears. And again, Jay Powell saying that, admitting that there is now a risk of recession. What does that mean for the commodity space, Mark?
Yeah, good morning, Tom. I think everyone's very focused on WTI this week and generally the oil prices, and that makes sense. But I wanted to draw attention to copper, which really is the most important industrial metal. We have had zinc, aluminum, and tin have their moments in the sun some points earlier on this year. But overall, it's all about copper for a best judge of the economy. We used to call it Dr. Copper. That might have been a slight exaggeration of how powerful was an indicator, but it does still matter. Now, it is down at a 15-month low. low. It's 20% off the highs. And this is because the world is getting really excited by the idea that there are going to be recessions in several major economies, perhaps a global recession. And an extra angle is particularly in China. China is the biggest consumer of copper. So the fact that we're getting more negative in Chinese growth, and this clashes with the story overnight that President Xi Jinping reiterated the determination to hit their growth targets in China and that they'll provide more policy support. We've heard that positive rhetoric before, and traders just don't believe that, and copper shows that. One extra tangent to the story: it's not just about recessions, it's also about a little bit of waning enthusiasm for the ESG green theme of the last few years. So part of buying copper is the electrification of the world. We move away from fossil fuels, but as we've got an energy crisis, suddenly we're seeing a new enthusiasm for coal plants, sadly perhaps for the climate and the environment, and that means that many people are going, hey, maybe this idea that the whole world's going to be electric and we're going to need endless copper forevermore, maybe it's an extra few years down the line and we need to change our demand calculations. The important thing to draw attention to here, though, is this is not a supply story. This is about a demand story, and at the moment we're very, very negative on that demand picture, and I think it can retrace even lower again.
Yeah, the negativity around copper on the breakdown of what's happening in ESG, and of course the question marks about that demand growth picture out of China. MLive Managing Editor Mark Cudmore, thank you. Okay, speaking to lawmakers yesterday, then Fed Chair Jay Powell gave his clearest acknowledgement yet that a recession was indeed possible in the US.
Ongoing rate increases will be appropriate, expeditious progress toward higher rates. We know we need to have restrictive policy, and that's where we're headed. The American economy is very strong and well-positioned to handle tighter monetary policy.
If interest rates go too high, too fast, it could drive us into a recession?
It's certainly a possibility. The other risk, though, is that we would not manage to restore price stability and that we would allow this high inflation to get entrenched in our economy. Price stability is really the bedrock of the economy. We must restore price stability, and we will. The public should believe that we will get inflation back down to 2% over time. We are strongly committed to restoring price stability. We do understand that it is the thing that we need so that we can get back to the kind of labor market that we all want.
Okay, let's get into the key market drivers now with our MLive editor, Eddie van der Walt, and Didier Borowski as well from Amundi Asset Management, head of Global Views. Eddie, let's start with you. We saw this in the presser as well from Jay Powell, edging closer to conceding that a recession is becoming more likely. And he seemed to clarify that in his statements to Congress. What is your assessment of where things stand in terms of how Jay Powell, the FOMC, are thinking about the recession risks now?
Well, look, I think what Powell was really saying, that a recession is a price worth paying for, if you pardon the pun, price stability. I think he's saying that, look, we really need to get inflation under control, and if that means a little bit of a hard landing, so be it. Because the one thing that he said over and over again that we heard from that clip was price stability, and I think that's their absolute primary goal at this moment in time. And I think that therefore, they will accept a little bit of softness in the housing market. Obviously they don't want to crash the economy, but I think they will settle for a couple of periods of negative growth even in the US, if that means they can put price pressure under control.
Okay, and you talk about the housing market, and we're seeing, of course, mortgage rates in the US get to around 6%, and of course, sales starting to soften as well. Didier, let's bring you in at this point. What is your assessment of the recession risks in the US? And if you do see a recession, as Will Dudley, of course, formerly of the Fed, says is looking inevitable now, if you do see that recession, what form does that recession take in your view?
Well, we don't expect a recession, I would say, in the best case scenario. That said, we fully agree with what Chair Powell said yesterday. It's a distinct possibility. The first sequence in terms of monetary policies to anchor inflation expectations. It's a very hawkish stance, so they will continue to hike rates aggressively in the short run. And if you look at the yield curve, for instance, it's likely to invert by the end of 2022 or early 2023. And the fear of a recession will remain there. Not immediately, I would say, but for late 2023 or 2024. So my point is that from a financial market perspective, that's true that it is a sword of Damocles if financial conditions start tighten too rapidly. That being said, I think we must be clear. It's quite easy in the short run to be very hawkish when inflation has not peaked and gross fundamentals remain quite solid. And it's another thing to continue to hike rates aggressively, I would say, in the second half of the year when inflation will slow, even if it's a mild slowdown, and if GDP growth slows. So our point is that the Fed is likely to be much less hawkish in the coming months, in the second half of the year. But do not forget, the first sequence in terms of monetary policy has not ended. It's very hawkish, and the Fed will continue to hike rates aggressively in the coming months.
Well, that comes down to the point, doesn't it, which you've illustrated, which is the stomach. How much stomach does the Fed have to drive down growth as they try to tackle inflation? And do you think in the market pricing, because we're starting to see now markets pricing, that maybe you get to peak rates towards November this year, and then possibly you get a pause or you get some kind of drawdown from the Fed? How are you assessing the kind of rate trajectory on that, Didier?
So first, 0.70, like 0.075 in July, and after the Fed will diminish the pace of rate hike, 0.50, 0.25, etc., reaching 3.5 and 3.75% in early 2023. My point is that at some point, the Fed will probably adopt a hawkish stance. We organized our Amundi Global Investment Forum 10 days ago, and there was a key question that was raised. Is Jay Powell likely to be Arthur Burns, like the Fed chair during the 70s until 78, 79, or someone like Paul Volcker? He seems to be someone like Paul Volcker in the short run, and we agree. That being said, we disagree that he will continue to hike rates as aggressively in the second half of the year when GDP growth will start to slow. We expect subpar growth, and it's another environment. If inflation starts to slow, if GDP growth starts to slow at the same time, probably the pressure on the Fed will not be that high. And with this inversion of the yield curve, you will have this recession rhetoric that will stay for sure intact in the coming months.
Okay, so Paul Volcker, I love that. Paul Volcker in the short term, maybe Arthur Burns in the longer term. Eddie, let's bring you back in at this point then, and taking what we've heard from Didier in terms of the assessment of the trajectory from the Fed and overlaying that to the energy space. Oil under pressure again today, Eddie. Are we starting to see signs of demand destruction?
Yeah, you know what? I think we are a little bit. I think certainly the market is pricing the possibility of demand destruction, but we are seeing that U.S. consumers and others, are attempting to drive less. Of course, it's very hard to drive less when people need to go to work and so on. But right now in the work from home environment, people have the option, and they're saying, look, I'm going to stay at home. I'm going to not fill up the tank quite as often. I think that question about whether we are going to see a Volcker-esque Powell in the short term is, I think what's a bigger question is the economy ready to stomach a Volcker in the short term? And I don't think it is, right? I think we are seeing it in things like the copper market, in things like the oil market, where we're seeing, the commodities market, which had kept really strong throughout all of this, just starting to back off a little bit now.
Eddie, just briefly before we let you go, your views on what we've heard from Germany now, activating phase 2 of their emergency energy plan. We know that we saw those gas cuts from Russia last week. What does this signal about the strain on the Eurozone economy and how Germany is attempting to shift?
Yeah, look, Germany has absolutely no choice here. I think Germany would just absolutely needs to fire up some of their coal plants because, if they're not going to get natural gas, they're going to run out of, they're going to run out of heating in the winter. But this winter is different from the last winter. This winter, they've had time to prepare for it, right? So I think that's a very different situation that we're seeing here. But the consequence is that, in the short term, I think demand for coal is going to increase significantly, and we could also see, companies like Glencore doing well with their large coal exposure.
Okay, MLive's Eddie van der Walt there. We'll continue that debate over Volcker versus Arthur Burns when it comes to the Fed, and of course the impact on the energy and commodities complex, the announcement from Germany, they're moving to phase 2 of their emergency gas plan. Didier Borowski, Amundi Asset Management Head of Global View, stays with us. We'll get more of his views and his calls in the next couple of minutes. Right, coming up, recession concerns whipsaw markets, as we've been discussing. We'll look at how Europe is faring and continue our conversation with Didier from Amundi Asset Management. Again, we'll get more of his calls in the next few minutes. Stay with us. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. 15 minutes into your European trading day, you're seeing losses of 0.9% across the benchmark. We still have some redheads and breaking news now, some data out of France, PMI data for the month of June, and it is a miss. It's a miss for both the manufacturing PMI and the services PMI. Let's start with manufacturing then. The data coming in for the month of June at 51, so still just about in expansionary territory, but well below the forecast of 54. And let me just check in on where this relates then historically. I'm just looking back through the recent numbers, and that is the lowest print, I believe, since early 2021 then for manufacturing out of France. That is the softest print that we've seen since around January of 2021. When it comes to services, the number is 54.4. So again, comfortably in expansionary territory for services, but below the forecast of 57.5. So pretty solid misses in terms of the services and manufacturing PMI out of France, just giving a sense of the softness that you're starting to see in this Eurozone economy, and the challenge, of course, for Madame Lagarde of the ECB as she weighs up the inflation risks and, of course, the challenges and the drag then on the economy. So just recapping, 51 for June manufacturing PMI out of France, the forecast had been for 54. Let's get some analysis then from Didier Borowski, Amundi Asset Management Head of Global Views. Didier, what do you make of this data and your assessment, how it rounds out your assessment of the health or the lack of health of the Eurozone economy?
The Eurozone economy is on the verge of a technical recession, so we are not that sure that we'll see a technical recession with 2 consecutive quarters in negative territory, but basically we are very close to economic stagnation for the coming quarters. So clearly demand is under pressure, much more than in the United States. The ECB will have less room for maneuver to normalize its monetary policy in this environment for sure. So and we don't rule out, and that's very important for equity markets, we don't rule out an earnings recession in the Eurozone, which is not at all priced in by markets as of today. So we really need to be cautious when it comes to Eurozone fundamentals. You know, the war in Ukraine has been a huge shock on commodity prices, and it's an asymmetric shock with the Eurozone and Europe, which is the first region which is hit by this crisis. And we see the consequences, I would say, of this huge commodity shock on commodity prices.
Indeed, and we're starting to see the pressure, of course, on the single currency as well. Euro-dollar, euro moving lower on the back of this significantly weaker data out of France. Didier, what is your assessment? You're underweight equities. What do you need to see to change that view?
Well, the fact is that we believe that many analysts are still too optimistic when you look at the earnings forecast. We continue to believe that earnings will be under pressure. That's true, as I said, in the Eurozone. That's also true in the United States, where margins will get under pressures, where global demand is set to slow. And in these conditions, and in addition to that, we must acknowledge that we will see a higher level of structural inflation in the medium term. And in this environment, the derating of global equity markets has not ended yet, we believe. You have, on the one hand, the downward pressure on earnings that is still not well priced in by markets. And on the other hand, the global derating related to a higher level of inflation that has probably not ended. So we really need to be very, very cautious. It's really too early in this cycle to say that it's an entry point. So we need to be very careful. And we need to be very careful because also volatility is very high, in particular on bond markets, which is not something which is traditional and which is clearly related to the uncertainty regarding monetary policies.
Yeah, indeed. We continue to see that very high and pronounced volatility. The derating of the equity markets is not over yet. That is the call from Didier Borowski. Thank you. We appreciate your insights, as ever, from the Amundi Institute, head of Global Views. Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. JP Morgan is laying off hundreds of US staff who work on mortgage lending and reassigning hundreds more this week. Bloomberg has learned the total affected will be more than 1,000 workers. Rapidly rising US mortgage rates have driven down demand in what had been a red-hot housing market. China has approved a plan to promote what it calls healthy development of the payment and fintech sectors. A meeting chaired by President Xi Jinping also backed enhancing regulation of major payment platforms. Beijing has promised to unwind a sweeping crackdown on tech companies that ensnared sectors from online education to gaming. That's the Bloomberg Business Flash. Tom.
Okay, Laura, thank you very much indeed. Coming up, Tesla burns money, as Elon Musk says. The company's new plants in Berlin and Austin are losing billions. We'll get the details on that story next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. 23 minutes into your European trading day, and some weak PMI data out of France pushing the broader benchmark lower here in Europe by almost a little over 1%. In fact, the CAC count is lower by 62 points. You've got the euro under pressure, down 0.3%, and there's a move into sovereign debt, particularly bonds. You're seeing a marked move there, and yields lower on German debt as part of this risk-off mood on the back of that weaker than expected French data. Let's get to what's happening with Tesla then. Elon Musk says the company's new plants in Berlin and Texas are losing, quote, billions of dollars. That's as the electric vehicle maker tries to ramp up production. Let's bring in Bloomberg's Craig Trudell. Craig, why is it difficult then for investors to break down and pass these comments from Musk? What should they be making of this seemingly warning sign, or sounding off a warning about what's happening at these factories by Musk?
Yeah, what's tricky about these comments is they were filmed all the way back on May 31st. So it was a little bit of a curious decision by the group that conducted this interview with Musk. It was the Tesla owners of Silicon Valley that waited to post this just not until Wednesday. And so obviously a few weeks have passed since then. It's hard to sort of, discern just how much has changed in those few weeks in terms of whether Tesla has, managed to sort of smooth out some of the challenges it was having with ramping up these factories. But what we do know is that in Shanghai, that there has been some spooling up of production there. Of course, these comments were more so, focused on the factories in Germany and Texas that are brand new. And there were sort of, red flags going into those plants starting production that it was going to be tricky. The company is trying new things, new types of battery cells in Texas that they're trying for the first time, a new style of sort of, installing the batteries in a structural way underneath the vehicles. And so, going in, there was, sort of some warnings by Musk to sort of set expectations, for the idea that it was going to take some time for these factories to get up and running and may not, they may not ramp up as fast as Shanghai did.
Yeah, Shanghai probably set a pretty high bar on that front. Craig, what does this mean kind of longer term for the production challenges of Tesla? Amid, Musk has said how much demand there is, just briefly.
Yeah, so it's going to mean that they're going to be highly reliant on Shanghai for the foreseeable future, and of course California, the other plant, and they really need to sort of prove that they can get that new type of battery up and running in order to sort of reach the kinds of volume objectives that investors have been sort of baking into the stock over the last year.
Okay, Craig Trudell on these latest comments from Elon Musk about the challenges for those production and factories in Berlin and Austin, Texas. Thank you. Coming up, the odds of the Fed's rate hiking cycle extending beyond the November policy meeting, well, they've diminished sharply as traders continue to reprice the prospects of a hard landing. Stay with us. More next. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya
kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Jay Powell tells Congress a recession is possible, as steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Stocks and futures lose ground as growth fears occupy the forefront of investors' minds. Bonds rally and the euro falls on the back of big misses on French PMI. We have the German PMI data also coming in as a miss for the month of January, both manufacturing and services. We'll detail that for you shortly. Elon Musk says Tesla's new plants in Berlin and Austin are, quote, giant money furnaces, losing billions of dollars just days after clarifying to Bloomberg that he plans to cut 3.5% of its global workforce. Let's bring you back to that breaking German PMI. It's a redhead across the terminal. And as I mentioned in those headlines, it is a miss when it comes to manufacturing data for the month of June out of Germany. 52 is the number. The forecast was 54. And in terms of services PMI, that fell to 52.4. The forecast was 54.5. Let me give you some historical context for the manufacturing data then, that number of 52. Again, the forecast was 54. Let me bring you back to the lowest point that we saw then. That seems to be the weakest print since, if I'm getting this right, just looking at the terminal, since around August of 2020. That is the weakest print then in terms of manufacturing data and PMI out of Germany, it appears, since around August of 2020. So another miss, building on the misses that we saw out of France. And you've seen a big move then into German debt, and you're seeing yields lower, price up on German debt. Euro under pressure, down now 0.5%, 105 on euro dollar, 1.5 on the German 10-year. Look at that, a 12 basis point move lower as money goes into German bonds, safe haven bids. The DAX currently trading lower by 1.3%, and the broader benchmark lower by 1.2%. Let's get some analysis then and reaction to this data with Christian Keller, Head of Economics Research at Barclays Bank. And what an opportune moment to bring you in, Christian. What is your take then on the data that we've seen out of both France and Germany?
Good morning, Tom. Yeah, unfortunately, we think it's a harbinger of things to come. We have been turning quite pessimistic on Europe. And mind you, we went into this year thinking this would be Europe's year, coming out of the pandemic with NGU and all this, support from the EU. This has turned dramatically. Europe is clearly the region that suffers most from the war in Ukraine, from the high energy prices, from the supply chain disruptions in China. And, we now see actually a mild recession in the fourth quarter and the first quarter next year for Europe, i.e. coming the winter. And I think what we're seeing here is clearly signs we could see earlier already. Manufacturing was strong, but it was basically working off the backlogs of past orders. Orders going forward, new export orders, etc., were already slowing. And even though the services were supposed to rebound, and we think the summer will bring tourism, etc., but there's a massive loss of real income for consumers. Consumer confidence, if you saw that yesterday, fell very, very deeply by the European survey. So this is unfortunately pretty much a perfect storm for Europe, really.
The perfect storm for Europe. Is this a demand problem then, Christian? Is this the lack of strength within the consumer base across the Eurozone? Or is this a pricing problem, an input and cost problem, an energy problem for the manufacturers?
Unfortunately, I think it's the two coming together. I think, it's certainly a massive supply shock when it comes to energy. Natural gas prices in Europe, I don't need to mention to the audience, but, they're very high. That's a massive supply shock. But at the same time, as inflation is now 8-9%, in some countries actually double-digit in the euro area, the consumer obviously feels this as well. So it's turning into the demand problem as well. So really, it's the ugly thing about it. It's a combination of the two. And obviously, we have a central bank that needs to address inflation, will start hiking rates, and that means that we're seeing a tightening of financial conditions. So it's really everything coming together.
Do you think any of the data today at all changes the calculation of Madame Lagarde and the ECB?
This is, I think, the unfortunate situation that central banks are in, not only in Europe, but elsewhere. They have to address inflation, and they have to, I think for the ECB, they will have to get out of the negative rate, regardless of the fact that they see a slowing economy. I think they will make the moves in July and also in September. We see afterwards, but I think the two moves in the next two meetings are pretty much baked in.
We talked a lot and we heard a lot about corporate strength during the pandemic as companies became and made their operations leaner, built out their balance sheets. To what extent is there resilience still in European corporates?
I think this is a good point, and this is why when I just told you that we are looking for mild recession coming in the winter, it is one of those recessions where consumers will cut back as they feel the real income shock. But we don't think there's really much hiding in the balance sheets. We don't think that there's a larger exposure that corporates suddenly could things could turn out uglier than we already foresee. So I think it's a good point that balance sheet in general are quite robust, and I think that remains to be true.
Unlikely to see skeletons in the closet when it comes to these balance sheets. If we overlay the risks of Russian gas being further cut into the Eurozone, presumably that changes your view on a softer recession in the second half of this year.
Yes, unfortunately, that would be. Right now we're seeing disruptions. We are already watching very, very carefully the fact that Russian gas supplies have started to sputter, so to say, in the last few weeks, which means probably that Europe cannot fill their storages over the summer as they were planning to. And if you get to true rationing of energy in Europe, in particular in Germany and Italy, and I know that there's a lot of diverging views on how bad it would be, but it would, in our view, pretty certainly a recession for a quarter or two, and it would be deeper than what we forecast now. Because once you have to cut off production, there's no doubt that you would get, possibly several percentage points of a recession in a country like Germany.
And when it comes to the single currency, 105 currently, down 0.5%. Do we get to parity, Christian? And how much of a challenge would that pose for the ECB and indeed policymakers across the Eurozone on the back of these very high levels of inflation?
That's a very good point, because I think we've heard from the ECB, obviously, for the first time in the last few months, that they were getting concerned about the currency. I mean, indirectly, they, of course, refer to the pass-through. A weak currency means for these energy prices that are already elevated and other imports. And that is another reason why they have to tighten from here. We see actually the euro in the next few months going weaker. I think our forecast is 102. I think if it came to a proper cutoff from Russian gas in the kind of deepest recession scenario that I just alluded to, we could see parity and below. I think that is possible. The dollar overall looks overvalued by most measures, but the dynamics in the global economy and all these shocks that are looming are unlikely really to weaken the dollar in the next few months, in our view.
Christian Keller, Head of Economics Research at Barclays Bank, on the perfect storm facing the Eurozone. Thank you for your analysis this morning, breaking down the data we're getting out of France and Germany. Coming up, EU leaders later today are expected to grant Ukraine candidacy status, paving the way for the country to join the Union. We've got more on that story next. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Welcome back to the Open. We are 41 minutes into the European trading day. Sharply risk-off moves that we're seeing as investors assess the data coming out of France and Germany. Barclays saying it is the perfect storm now for the Eurozone. Losses of 1.3% across your equities. Sharp moves lower in terms of yields across bonds. Moves of money into that debt on this safe haven move. The euro under pressure, down now 0.6%. Speaking of the euro, European Union leaders are gathering in Brussels, where later today they are expected to grant candidate status to Ukraine, along with Moldova and Georgia. For more, we are joined by Bloomberg's Europe correspondent Maria Tadeo. Maria, we could see potentially what would be an historic move then today if EU leaders approve granting this candidacy status for Ukraine. Is that likely, and what would that actually mean practically?
Well, Tom, I would say it's very likely. And we just heard from the German Chancellor, of course, Olaf Scholz right now, who gave a very clear indication in terms of the way that things are going to play out. He did say Ukraine, of course, has done the work for this. Remember, a week ago, he, alongside Emmanuel Macron and Mario Draghi, went to Ukraine. The head of the commission has been there now multiple times. And of course, the idea is that they will now endorse this candidacy for Ukraine, which, of course, is a boost of morale for the country in the midst of this war with Russia. It also shows how much things have accelerated as a result of the war in Ukraine. This has been a long-time aspiration for the country that is now really manifesting itself as a result of the war. Now, in terms of the practicalities, the reality is, Tom, there's a big difference between being a candidate country to the EU and being a full member to the EU. And of course, that can take a very long time. The Ukrainians know this. There will be conditions on things like rule of law, corruption. All of this is very well known. And of course, reforms that will have to take place in the country. But over the short term, this is the win that Ukraine wanted to see politically, and is the symbolic move, of course, that the European Union is now willing to grant the country in the shift away from the Russian sphere of influence into Western Europe.
Okay, so a political win for Ukraine looking pretty inevitable, as you say. Of course, the issues around energy security front and center as well for officials there in Brussels. Germany moving to stage 2 of its emergency energy or gas plan. What do we know about how the discussions are unfolding there and the question of energy security?
Well, listen, Tom, this is not officially on the agenda, but I can tell you it really is a topic on everyone's minds here. There's really serious concerns that we could now see escalating unilateral moves from Russia. Remember, there has been a continuous decline in supply to countries like Germany and Italy. Perhaps that is a warning shot in terms of what to expect for the winter and the storage ahead of the winter. Remember, this is the most vulnerable time of the year for the European Union, some of them entirely depending almost on Russian gas. So this is a serious concern. They worry about potential outage, but also full-on retaliatory measures from Russia and a real rupture in terms of the supply. So this will be, again, not officially on the agenda, but this is a real concern for them. And you talked about this perfect storm that's about to hit the European Union. Well, they really worry about the impact of this, especially as we enter the winter.
Okay, Bloomberg's Maria today on the ground looking at that Ukraine candidacy status and, of course, the discussions, unofficial even as they are, around energy. Right, let's turn our attention further to what's happening in commodities. Oil hit again amidst growing recession angst. And, of course, Jay Powell admitting that a recession is a risk now for the US. For more, we are joined by Bloomberg Executive Editor for Energy and Commodities, Will Kennedy. Will, let's start with what's happening in Germany, the move to phase 2 in terms of its emergency gas plan. What does that mean in practice, and how are they hoping to shore themselves up in the eventuality, if it does come through, that Russia further cuts supplies?
Good morning, Tom. Yeah, so stage 2 is stage 2 of 3. They've outlined different phases they go through as the gas crunch gets worse, and it signals that Germany believes there's a likelihood of sustained disruptions to supply in the coming months. This is, of course, after supplies on the Nord Stream 1 pipeline, the main link between Russia and Germany, fell to 40% of its normal levels. In practice, it will mean that Germany may be able to pass on higher oil and gas costs to consumers in a way that would previously have been illegal. So it would perhaps mean constrain demand and help out oil and gas and power suppliers. And it may allow them to turn on more coal-fired power plants, something they flagged up a few days ago. The idea of bringing coal-fired power plants that had been scheduled for decommissioning out of mothball state and use them to replace generation from gas-fired plants, which won't have as much gas available.
Okay, so that on how Germany is trying to kind of shore up its defences around any potential further cut to gas. When it comes to oil, Will, we're seeing further pressure on Brent WTI this morning. Are we starting to see signs, do you think, of demand destruction, or is this a knee-jerk reaction to the risks around recession?
Yeah, it's been quite a dramatic sell-off. I mean, we're down more than 20% over the last few weeks, which is the definition of a bear market. I do think it's quite a difficult market to read right now. This selling off is coming in a market that's been volatile all year and where liquidity hasn't always been as strong as it has been historically. There are players who are reluctant to trade this market. But clearly it's telling us something. Is telling us that there are investors out there who think that the rally may be done, that there are good macroeconomic reasons to take money off the table, and that, you know, the market isn't as strong because of the recession fears that you mentioned. On the other hand, when you look at the physical market, that still looks tight. When you look at the prices people are paying for diesel, in the UK right now, we're paying a record for diesel, £2 or thereabouts, so a litre. That's not a sign of a softening market, and that's not a sign of a market that's about to give inflation a hand. So there may be early signs of demand destruction. You've got to think at those sort of prices. People are going to think about driving a little less, but I don't think it's abundantly clear. And refiners are still producing all the fuel that they can, and inventories both of crude oil and fuel around the world are still dropping. So perhaps, but it's one for the future, and right now it's too early perhaps to say that we are seeing the demand destruction that you mentioned.
Okay, as ever, excellent. Thank you, Bloomberg's Will Kennedy, for breaking down what we're seeing across these energy markets. Oil now technically in a bear market. Let's check back in on what's happening across the yield space. German bonds bid significantly. You're seeing yields down almost, let's check in on the 10-year, 14 basis points, but the action really at the front end as well. The 2-year German bund now yields lower by 18 basis points. So significant moves into German bonds. A flight to safety. The euro dollar also lower by 0.5%. Is this going to challenge then, Madame Lagarde, the ECB as they they've reiterated their determination to press ahead with hikes in both July and September. They, of course, have yet to hike, but it was that weaker data in terms of manufacturing and services, both out of France and Germany. Barclays saying the Eurozone now faces a perfect storm, but there's significant moves within these bond markets. We'll continue to keep across them for you. Let's get the first word news now with Laura Wright. Laura.
Thanks, Tom. Federal Reserve Chair Jay Powell has given his most explicit acknowledgement that steep rate hikes could tip the U.S. economy into recession. He told the Senate Banking Committee that achieving a soft landing will be very challenging. Powell restated the need to ensure that high inflation doesn't get entrenched in the economy. The Taliban's supreme leader has made a rare public appearance to plead for international aid after a devastating earthquake hit Afghanistan. At least 1,000 people have been killed and hundreds more injured after the 5.9 magnitude quake hit the southeast of the country. The disaster risks a new humanitarian crisis in a country already facing hunger and a crumbling economy. Almost 1 in 5 U.S. adults who have had COVID-19 are currently experiencing symptoms of long COVID. The survey by the U.S. Census sheds light on how frequently symptoms linger 3 months or more after the initial period when people are sick. Around 40% of Americans reported ever having had COVID in the survey. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Tom.
Laura, thank you. Coming up, JP Morgan lays off hundreds of staff in what has been a red-hot housing market in the US. More on that next. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
The biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. 52 minutes into the European trading day. Pronounced risk-off or recessing, of course, the comments from Jay Powell, who admits and concedes that there is now a risk of a recession in the United States. Meanwhile, here in Europe, you're looking at data from Germany and France. Manufacturing and services coming in much weaker than expected. Pressure in the Eurozone. What it means for the ECB. You've seen significant moves into German debt, German bunds, and yields there on the 10-year German bund down 13 basis points. 15 basis points move lower on German 2-year as you see a bid for German debt as this risk-off mood solidifies. Euro-dollar is weaker. The euro-dollar is down by 0.5%. And across the benchmark equity space, you're looking at losses then of 1.3% currently in the session. Okay, let's take a look at some of the other things to watch out for today. 10:30 a.m. UK time, the EIA will publish its latest crude oil inventory report. That's as the oil market, as Will Kennedy was telling us, is now technically in a bear market. Then at 1:30 p.m. we will have the US initial jobless claims data. We'll see how that informs the FOMC. That is followed at 3 p.m. by a summit of European leaders in Brussels, where they are due to discuss energy, the cost of living, Russia's invasion of Ukraine, and the membership applications of Ukraine, Moldova, and Georgia, as Maria was telling us. At 9:30 p.m., the Fed reveals the results from its annual bank stress tests. And later today, Fed Chair Jay Powell testifies before the House. He testified in front of the Senate yesterday. Today, it's the House Financial Services Panel, listening out, of course, for anything else he has to say about the recession risks. Okay, let's talk about how inflation is impacting not just consumers, but the banks as well. We have the stress tests, of course, but we also have mortgage rates in the States now around 6%. JP Morgan is laying off hundreds of staff in their US home lending unit as rapidly rising mortgage rates drive down demand in what had been a smoking red-hot housing market. Tom Metcalf joins us for the details. What does this tell us, the case of JP Morgan, illustrate to us about what is happening in the housing market in the US? Is this a one-off? Are we seeing this more broadly now as we start to readjust in terms of that demand and higher rates?
Yeah, well, it's that adjustment we're seeing and that real-world effect. You know, obviously, you've seen these interest rates rise, and here's what kind of the real business impact is. So JP Morgan, enormous lender, particularly in mortgages, and it's cutting, I think, about 1,000 jobs from its mortgage business, and about 500 of those aren't coming back, so it's reallocated, you know, about half.
And prices are coming down, rates are going up. Is there variance across different parts of the US, and there's a variance in terms of how different lenders are adjusting to this? How long do we expect this to continue, and how closely tied is it to what's happening with the Fed?
Well, it's obviously directly tied, obviously, the wider economy as well. I mean, you look back, it's been a very hot housing market, so some of this is just a sort of natural, you know, cooling off. But it's interesting to hear those Powell comments you mentioned, right? Doesn't sound like it's going to be a short-term fix in any sort of sense of the word. Yeah. So suspect this will just be the start of many kind of painful announcements like this for lenders. Okay, so this is JP Morgan. You expect others to come out. Have we heard from other lenders at this point? How many other businesses are starting to pull back and cut staff? Yeah, the other big one was Wells Fargo. So that's actually the US's biggest lender. So they've done something similar. And then also firms that people may not have heard of, Redfin, Compass, they're all in the sort of mortgage business. And they too have similarly said, hey, we're retrenching, we're cutting jobs, we've perhaps overexpanded in the good times, and now we need to get back to the right side. So retrenching, as you see these much higher rates in the US around mortgages, and of course that softer demand, at least in some parts of the US market. Tom Metcalf, thank you, on the impact on the banking space there on a day when, of course, you're going to have those stress test results as well from the Federal Reserve. Let's check in then on the markets before we wrap up European market open. And you're seeing, again, as I said, risk off, you're down 1.3% across the European benchmark. Future stateside pointing to losses between 0.6% on the S&P minis, 0.4% on the NASDAQ futures. You've been a significant move into sovereign debt, particularly the sovereign debt of Germany, where you've seen 16 basis point move lower on the 2-year, 14 basis point move lower on the 10-year. Stay with us. Surveillance Early Edition up next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data.
I would say we have a 50% likelihood of a recession globally, but also in Europe.
I would expect a mild recession like 1990 or 2001, not a deep recession like 73, 74, or of course the great financial crisis.
It is going to be very challenging. It has been made significantly more challenging by the events of the last few months.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, standing in for Francine Lacqua. And here's what's coming up on today's programme. Jay Powell tells Congress a recession is possible as steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Stocks and futures lose ground as growth fears mount, bonds rally, and the euro falls on the back of big misses on European PMIs. And Elon Musk says Tesla's new plants in Berlin and Austin are giant money furnaces, losing billions of dollars. That just days after clarifying to Bloomberg that he plans to cut 3.5% of its global workforce. Let's check in on the markets and bring you some breaking news. It's been a big day for breaking data. We've had misses when it comes to Eurozone manufacturing and PMI data. Let's start with France and Germany. Those are both misses. In terms of the top line, when it comes to the Eurozone, just bringing you the numbers then. Eurozone manufacturing for the month of June, 52. That's a big miss from the previous month, and it's a miss from the surveys as well. The expectations had been you'd get 53.8. The actual number across the Eurozone when it comes to manufacturing is 52, significantly down from the previous month as well. 54.6 was the number in May. So it's 52 for June, Eurozone manufacturing. When it comes to services, also a significant miss, 52.8. The surveys had seen 55.5. And we have another surprise in the central banking space. Norges Bank raising its benchmark interest rate to 1.25%. The estimates had been 1%. So it's a surprise move by Norges Bank in Norway. Again, as central banks reassess the impacts of inflation and the potential drag on growth. It's a surprise move by Norges Bank. And softer data, further soft data out of the Eurozone. We had Barclays earlier saying that the Eurozone now faces a perfect storm. We are joined now for analysis by Andrew Balls, CIO for Global Fixed Income at PIMCO. Also with us, our European economy reporter, Alexander Weber. Alexander, let's start with you on the data that we've had, the surprise move, I should say, out of the Norges Bank. A higher rate move out of Norway. What does that signal to you about concerns about inflation and how far and how hard these central banks need to go?
Also, Norway hiked by 25 basis points. It's not as strong as the 50 basis points that the ECB is honing in on, and even further away from 75 basis points that the Fed hiked. It's the interest rate is a relatively effective tool in Norway, so it didn't have to go as far. But it shows clearly the determination by central banks to get inflation under control, even as growth concerns mount.
Okay, so in fact, they did hike by 50 basis points. The rate came into 1.25%. The estimates had been for 1% in terms of rates out in Norges Bank. So it was a 50 basis point move. Andrew Bulls, just great to have you on a morning full of data. And of course, that surprise move by the Central Bank of Norway. What is your assessment at this point, Andrew, of recession risks and whether central banks are going far enough and fast enough to address them?
So recession risks are very elevated. I'm not quite sure is the 100% the baseline, but it's very high risk compared with normal times of recession in Europe, recession in the US. I don't think the central banks have got a great deal of choice. They need to tighten policy given where inflation is. This is something that we haven't seen for some time. In response to high food, high energy prices, central banks unable to look through it because the latest shock came, on top of already elevated inflation. In the U.S. case, I think it's quite likely you have a recession, given the extent of the inflation, the strength of the labor market. The Fed needs to slow the economy. Needs to get unemployment up in effect, and it's hard to do that and achieve the soft landing. On the European side, more of the inflation is from external factors. There's less in terms of excess demand growth in Europe, but it's certainly uncomfortable for the ECB, an inflation targeting central bank, to have inflation at these levels. Big constraint, of course, in Europe is the periphery, not only recession risks overall, but the sovereign-related risks, which complicates it further for them.
Well, indeed, and on that point, we're seeing significant moves into not just German bonds, but also Italian debt as well today. The Italian BTP yields down 11 basis points, currently at 3.43. German bond 10-year, 1.49, a 14 basis point move there. Is this just a significant risk-off move that we're seeing here in Europe, or is this a challenge to the ECB and the commitment to hikes in July and September?
So I personally think a lot is priced in for the ECB. The ECB didn't actually manage to hike rates in the last cycle. The economy's skirting close to recession, and there's less underlying inflation. So a lot is priced in for the ECB. So I'm not that surprised that we should see markets taking some of that back, just given the weakness of the data. Italy and the rest of the periphery is a concern. The ECB, is going to be hiking rates. They need to hike rates. The higher beta countries, it's not a great surprise that their spreads would have widened. And we have a big question now: can the ECB come up with something credible in terms of an anti-fragmentation tool? If you look at the history of the last 10 years, it normally takes several missteps before they come up with something credible. Credit where it's due, they came out and announced their intentions to put something together. You've seen significant tightening of Italian spreads during, risk-off difficult markets. But with ECB, the politics is always so difficult. Will they be able to come up with something to maintain, good progress here? Or will we have one step forward, two steps back, which, again, looking backwards, has tended to be the way the ECB operates?
Yeah, indeed, the challenge of politics as the Eurozone, and in fact the ECB, tries to confront that fragmentation risk. Alex, let's bring you back in at this point. We were talking to Barclays earlier. They talked about this perfect storm for the Eurozone in terms of growth and inflation. There had been some assumption that, yes, okay, manufacturing in terms of PMI is going to soften, but services should kick back in as a leg of support, and we're not really seeing that. Do you have an explanation for why services are so soft in the Eurozone as the pandemic weakens and people try to get out and spend more?
In one word, it's inflation. It's demand has softened considerably for services, and according to the business service by S&P Global that were just published earlier this morning, it all comes down to cost increases. People are very concerned about the energy bills. They are seeing daily staples getting more expensive on a daily basis, and therefore they're cutting back on recreation. Tourism has stalled the momentum. We could see some of that come back over the summer, perhaps. The holiday season is just beginning here in Europe, but it's the surprise weakening of demand was all due to cost increases. We saw Germany trigger phase 2 of its emergency gas plan today, which just signals how much concern there is about energy supplies and rising costs on that front. And that's just something that households can't escape, so they're cutting back on other expenses.
Okay, European economy reporter Alex Weber on the data we had out of the Eurozone, softer than expected. Andrew Ball's very pleased to say from PIMCO, staying with us. We'll get more of his calls after the break. Just breaking live pictures now of the German economy minister. And of course, Alex was just talking about this, the challenge around gas and energy in Germany. This is the economy minister, of course, addressing those concerns, saying that Germany faces now an energy crisis. They are moving to phase 2 of their emergency gas plan. It is a 3-phase plan. Russia, of course, cutting gas significantly last week. And we know that Germany is trying to shore up its supplies, even moving to fire up coal-fired power stations. So this is Germany's economy minister addressing and giving a press conference there, saying Germany will activate additional coal-fired power stations. Again, pretty remarkable from a member of the Green Party. Coming up, we will be taking and talking US politics with Moelis Vice Chairman and former US House Majority Leader Eric Cantor. Do not miss that conversation. It's a little later in the show. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Okay, PIMCO says it sees an elevated risk of recession over the next 2 years. That is due to geopolitical instability, stubbornly high inflation, and reduced household disposable income. It also says it sees positive returns on most bond benchmarks over the secular horizon. Andrew Bulls from PIMCO is still with us. Andrew, you've talked about resilience, the need to build in resilience in an increasingly volatile era, an area and a time frame when there's going to be less fiscal impulse. How do you start to build that resilience in?
Well, firstly, I mean, I think you wouldn't be surprised, PIMCO, to say this, but we think the bonds have a key role to play in overall asset allocation. We've seen this, difficult period for all financial markets this year, but you now see bond yields at, pretty attractive levels compared with, the past several years, and given the extent of central bank hiking priced in, there's also the potential for bonds to not only provide the returns, but the protection in the event of recession. And we do think that recession, as we discussed previously, is quite elevated in terms of the risk in the US and in Europe. So better starting valuations amid what has been a difficult time in markets these past months, and the important protection in the event of downside risk, and then more broadly build resilience in terms of your asset allocation, your fixed income portfolio as well. Fairly cautious on credit. One thing which is going to happen is if we are going into recession, central banks are not going to be able to cut rates quickly. Fiscal policy probably is not going to provide a lot of support. So in contrast to the last 10 years where central banks were suppressing volatility, supporting asset markets, we think it's going to be a lot more difficult going forward.
Okay, there's a lot to unpack there, Andrew, and it's great because we have no shortage of topics on which to focus. Is the 60-40 portfolio mix then back? And when it comes to, Andrew, when it comes to what you find attractive within the yield space, within the bond space, is it the short end that's looking more attractive? Just wondering if let's see if we still got you, Andrew, because sometimes we do have these tech difficulties on live TV. Andrew, can you hear me okay? Andrew, just checking you can hear me okay. Okay, it seems we're having technical issues then with Andrew Bulls, CIO for Global Fixed Income at PIMCO. Of course, their view, in fact, is that you could get to around 4% on the US 10-year. But as Andrew was saying, there are opportunities now, he sees, to add bonds, cautiously optimistic on things like credit as well. But they do, of course, and do say you need to build in resilience to your portfolios amid these higher recessionary risks. We will check in on the markets then, talking of recessionary risks, becoming more pronounced, arguably, on the back of the data that we had, disappointing data out of the Eurozone. Manufacturing and services PMI for the Eurozone for the month of June coming in below the estimates. You've seen the euro pressured on this. Euro dollar currently trading at 105, down 0.5%. But really, it's the moves in the bond markets that have taken most of our attention. The German 10-year, you're seeing yields lower by 13 basis points, 1.5 on the German 10. The German 2-year currently lower by 14 basis points. I think we have re-established the connection with Andrew Bulls. So let's bring Andrew back in at this point. Andrew, we're talking about resiliency in your portfolio markets and in your bond markets in terms of building out resiliency in these recessionary times. There's resilience as well from Andrew Bulls in terms of reconnecting and coming back to us. Let me end with a final question. What are the biggest headwinds, potential headwinds, Andrew, in the second half of this year? The biggest tail risks?
Well, I think in the short term, it is the combination of high energy prices, demand destruction that's going to come from that, and I think that's part of the story you're seeing in the European PMIs. But central banks that are going to have to tighten policy, keep tightening policy, given inflation is too high and has been stubborn. And then beyond that, looking further out, I think a combination of central banks that can't ride to the rescue in the event of this recession. And then secondly, as we look out over the next several years, as a consequence not only of the prior COVID period, the prior China-US trade wars, but now the Russia-Ukraine situation, a whole set of challenges where governments, companies are going to have to focus on building resilience in supply chains over maximizing efficiency in the medium-term implications. Your news today on Germany firing up the the coal power stations, focuses on energy security, food security, on the government side, on the business side, robustness of supply chains, friend-shoring, near-shoring. These are things which over time are not going to contribute a lot to economic growth, but may contribute to the ongoing inflation pressures.
Okay, Andrew Balls, CIO for Global Fixed Income at PIMCO. We appreciate your insights. In terms of hedges, Andrew's calling for exposure to tips, commodities and real estate. Thank you, Andrew Balls. Right, coming up, the UK is a long way from reaching gender parity in the workplace. That is according to a report from the Chartered Management Institute. We get the details next. This.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, standing in for Francine Lacroix. Now, the Chartered Management Institute's new report says that the UK would need, get this, 560,000 more female managers in order to achieve gender parity. We are joined now by Anthony Painter, Director of Policy and External Affairs at the Chartered Management Institute. Anthony, in fact, thank you for joining us. Give us a sense of the importance of this statistic and what it means about innovation and cost loss for businesses who are not propelling female employees to those management levels.
In short, it means a lot. And a lot of this debate has been driven by numbers, and we've put out some big numbers this morning around that gap over 500,000, as you said, Tom, rising to 800,000 by 2026, in fact. But why does it matter? Well, it matters because we know that businesses that have a properly inclusive culture, processes, organisation are more profitable, more innovative, more productive, more successful, and countless studies have backed this up. And this research goes into the depth of those studies from McKinsey, from the OECD, from Boston Consulting. You can just reel them off. And this matters to businesses, and it matters to the economy at large.
Anthony, you talk in this report about the fact that a lot of companies talk the talk, but they just don't walk the walk when it comes to improving the opportunities and improving the gender balance. What are they missing out? What are companies not doing that they should be doing?
Well, for a start, not taking it seriously and getting complacent far too early. There's been improvements. There's no doubt about that over the last decade or so. We're seeing more women in senior leadership roles, for example. We're seeing a more ethnically balanced workforce. However, the progress has been incremental and the congratulation has been large. And so the first thing they're not doing is facing up to the fact of how short we are. We don't have enough disabled people in organizations in managed leadership position. We haven't got enough ethnic balance. We haven't got enough people from socioeconomic backgrounds rising up the ranks of business and other organization. What should they be doing? They should be tracking it. They should be looking at the data. They should be setting action plans. Senior leaders should be showing leadership. They should be saying why this is important. It's not just a numbers game. This is actually about business success, about business sustainability. It's about us being successful in the future. All those things are absolutely necessary. And the businesses and other organizations that have taken those sorts of measures have seen gains.
Okay, so those are some of the concrete measures that could be put in place by companies. What about at the government level? What does the government need to be doing to lead by example on this?
We're seeing complacency in a lot of business, a lot of organizations. We're also seeing that same complacency in government. Government did some great things. You know, a few years ago, the mandatory gender pay gap reporting measures, that seems to have made a difference, right? So it was making a lot of progress. It's fallen behind now. And actually, you know, we had a sort of advisory council. We looked into research. We spoke to a lot of people. And a constant message that kept on coming back during the course of this research is that government is now lagging rather than leading. And we need government to lead. We need government to explain why it's important. We need to be pushed sort of mandatory measures. We need government to use its purchasing power to emphasize the importance of inclusivity, because that will force business and other organizations to change as well, force public services to change. So we need government to show more leadership in this environment because of the wider economic benefits. And just think about it at the moment. We're talking about skills gaps. We're talking about record vacancies. What an opportunity to close those gaps.
Okay, great stuff. Anthony Painter, Director of Policy and External Affairs, on some of the key and concrete measures both companies and government can be putting in place to address the lack of balance when it comes to gender. Thank you for joining us. Coming up here to talk US politics, we are joined by Mueller's Vice Chairman and former US House Majority Leader Eric Cantor. Stay with us for that important interview. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost that breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here are the top stories. Jay Powell tells Congress a recession is possible as steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Sounding the alarm, Germany's Habeck triggers phase 2 of Berlin's emergency energy plan. The Greens leader warns the country is in the midst of a gas crisis. Stocks and futures lose ground. Bunds rally and the euro falls after big misses on European PMIs. Ridgewater Associates discloses a massive position against European stocks. So there's Ray Dalio making his move against European stocks. That weaker data, Barclays telling us the Eurozone now faces a perfect storm. French, German and Eurozone Manufacturing and Services PMI all coming in below the estimates. We now have the UK coming out with its manufacturing data for the month of June. 53.4 is the number for the month of June out of the UK when it comes to manufacturing PMI. For the context, it is a marginal miss from the forecasts of 53.6. Not significant, marginal. Services PMI unchanged at 53.4. The forecast was for 52.9. So UK services coming in slightly better than estimates. 53.4 versus the forecast of 52.9. Again, this is for the month of June. Manufacturing a little softer here in the UK, and of course how this feeds into the decision-making of the BOE, which is expected to hike again, and its next meeting is the expectation from the markets. Let's turn, though, from the UK and the Eurozone to what's happening in the US, and particularly politics and the inflation overlap. President Joe Biden has called on Congress to implement a summer gas tax holiday in response to soaring energy prices. It comes as the president reiterated that a US recession is not inevitable following a conversation with former Treasury Secretary Lawrence Larry Summers. My next guest is Eric Cantle, Vice Chairman of the investment bank Moelis, but also, Eric, of course, a Republican, served as US House Majority Leader from 2011 to 2014. And for much of his career in politics, he was the only Jewish Republican serving in Congress. Eric joins me now. Great to have you in the studio. And of course, we have to talk about inflation. We have to talk about what Joe Biden, the president, is doing to try and get gas prices at the pump in the US down. Let's start with the impact on the polling numbers for the US president as he faces up to the midterms of November. Before we unpack what's happening in the energy space, is it now a given that the Republicans take control?
Well, Tom, first of all, I would say this from the Biden administration's standpoint. I think that you could say figuratively and literally they're out of gas. And obviously, literally, we're seeing the gas prices at the pump, which has prompted this administration to put forth the proposal yesterday for a gas tax holiday. But again, it's indicative of the fact that the administration's flailing. Even the Democrats on the Hill, Chuck Schumer and Nancy Pelosi, the leaders, have come out and criticized that proposal.
Would you back that proposal? Why does that not make sense?
No, it doesn't make sense at all. First of all, you can't guarantee that that's going to make its way to consumers. The way that the gas tax is levied in the U.S., it's not at the pump level. So it's at the import level or at the refinery level. So you don't know whether the consumer would ever even realize a benefit from that. Plus the fact that those revenues go into the Transportation Trust Fund. Anybody who follows that in the United States know that trust fund is underfunded, so you're just digging the hole deeper.
Okay, so I mean, they would say that the infrastructure plan is going to make up for that, but they would also push back and say, look, there are the geopolitical effects on their energy prices, and you mentioned refiners, that they're making a killing out of all of this. So to address those points, but also to say what policy reaction would be appropriate at this stage?
Well, you know, at this stage, there's no question there are multiple crises that are impacting the American consumer and affecting business decision-making in the U.S. So right now, I would think priority one is to make sure that we unleash America's potential as far as the ability to produce more oil and gas. And as you may know, Tom, the politics in the U.S. on the left are just vehemently against the administration doing any of that. So you've never seen President Biden take to the podium in the White House and say, we're going to do everything we can in our power. We have the resources here in the United States to answer the call of the consumer and to bring those prices down, just to give the market the signal the administration is not going to stymie the permitting process and the ability for more production. And they just won't do that.
Well, again, they would point out that they have eased back on some of the permitting, and they've had a meeting this week with energy executives from some of the oil majors. They would say that they are trying to do their bit, but they would also point out that the energy majors are making an absolute killing in terms of profits.
All the while, exactly. All the while, all they can do is go in and blast. On the one hand, they're saying to the energy companies, do more. On the other hand, they're saying, you are raping the consumer, so therefore you are bad and we're going to tax you. The whole thing is just, again, that's why I go say the administration is just out of gas, literally and figuratively.
You could impose a tax on the energy majors as they've done in the UK. That's a windfall tax.
How in the world would that help the consumer? I mean, right now you asked about politics and asked about Republicans and whether my party will win the midterms, and I would say today, absolutely, the Republicans will retake the majority in the House and will also in the Senate.
Okay, that's the prediction for November, and many would agree with you on that front. We've got the congressional hearings around January the 6th that have been unfolding over the last few weeks, and it's a reminder of the inability for your party to detoxify themselves from a president, of course, who claimed falsely and lied about this, that the election was stolen. We know that's conclusive. Where is the Republican Party in terms of trying to detoxify themselves?
Well, first of all, I would say, Tom, I was unequivocal on the day that happened and shortly thereafter, publishing an op-ed opinion piece in the Washington Post just declaring that when you don't tell constituents and the voters the truth, this is what happens. And so I have no tolerance for any of that. But I would say in the end, these items the Democratic Party is trying to put on display, I think they pale in a comparison of what American families wake up to every morning when they think about what they're trying to do in terms of managing their family budget. When you've got inflation running over 8% in the United States, you've got gas prices way over $5 a gallon on average at home as well. So unfortunate for the Democrats, fortunate for my party, but frankly, it's the American people that are losing because they can't quite keep up with the cost of living.
That is the here and now, and those pressures are real on households across the United States. But further forward, of course, the question of democracy, the very viability of U.S. democracy. You've talked about the need to tell the truth, but the Republican Party is still backing a number of candidates, many candidates, up and down the ballot, who continue to spread the lie that this election was stolen.
Look, again, I don't condone any of that, and I would say the overwhelming majority of my party is not in that camp of telling the lie. Number two, I would say anybody who says that democracy is threatened and our institutions can't withstand the pressure, on that day, there was a binary choice. The institution rose to the occasion in Congress. The institution of the courts rose to the occasion and struck down and dismissed every attempt by the Trump campaign to make those challenges. And so I would say we have a problem, though, in actually the everyday functioning of the government. I do think you're going to see that Congress produce this this bill on gun safety right now, and whether you're for it or you're against it, it does indicate that there is an ability for the institution of Congress to work. Now, I would say, back to my point about the administration, it's not coming from the leadership in the White House, and that's really what the process in Washington is missing right now, is strong executive leadership.
And it looks like that bill could get through, which would be remarkable, as you say, historic in terms of gun rights. When it comes to, in terms of putting in policies that may reduce some of these terrible shootings that we've seen across the US. But coming back to the question of Trump, does the Republican Party need to move on from Trump, or is he the most likely candidate still in 2024?
There's no question that, Donald Trump is the most impactful force in the Republican Party today. He is the most coveted in terms of endorsement in the primary processes, and I do think that he is the front runner for sure for the nomination of our party if he wants to run.
And to be clear, you would support Trump in 2024 if that was the case, despite everything he's done.
I'm a Republican, and I've always supported the Republican candidate. And again, just with the discussion we've had, Tom, the policies that are underway in the Democratic Party being commandeered by the progressive left are not the policies that will ensure America continues to lead. So I could never support those policies, and I am a Republican.
It's just many people will look at that and say, okay, maybe the Democrats have gone too far to the left on some of these issues. But then you have the central question, again, of a president who tried to manipulate the outcome of an election in the most powerful democracy on this planet.
Again, I think what's most important to the American people right now is the ability for them to see a future for themselves and their family, and the ability for them to afford the cost of living right now and the cost of life. And right now they're having a real difficult time in undertaking that challenge.
Okay, and that is the focus. Despite the fact that there are deep concerns, not just in the US, but outside the US. You must hear this all the time. And you kind of push back on that idea that democracy in the US is vulnerable at this point. But many outside and within the US are deeply concerned about this. And these are not people on the extremes.
Well, listen, I tell you, I'm concerned about the functioning of our government for sure, and I want to see it function. There is perpetual gridlock. That gridlock is reflective of the fact that the country is very divided and polarized politically. In the end, I think that greater forces will take over, and we're going to see a real potential for leadership again in Washington. Right now, we're just sort of reflecting what democracy produces, which is the polarization that is actually politically there across the country.
Well, there certainly is that polarization. Very pleased to say that Eric Kentor stays with us. We're going to talk about the markets, M&A, and where Eric is seeing opportunities, of course. Vice Chairman of the investment bank of Moelis and former US House Majority Leader, staying with us. Plenty more, of course, from Eric Kentor after the break. We'll talk as well about geopolitics, Ukraine, Russia, energy. Ukraine, by the way, taking one step closer to becoming a member of the European Union. We've got more on that story in a few minutes. Stay with us. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Eric Cantor, Vice Chairman of the investment bank Moelis and former, of course, US House Majority Leader, still with us. Very pleased to say. We were talking in the break about the geopolitics of Russia and Ukraine. Let's start with this. There has been some bipartisanship when it comes to how to address the challenge of Vladimir Putin and the war in Ukraine. Does that hold up, or are you starting to get a sense that maybe, amid all the inflationary challenges you were outlining for us before, that there is some sense of Ukraine fatigue set in within the body politic of the US?
Well, Tom, first I would say I think overwhelmingly the American people support the cause in Ukraine to stop an aggressive move by Vladimir Putin, just busting all international norms, invading a sovereign nation, and frankly, the absolute devastation he's caused to Ukraine. I think there is, yes, consensus in the United States that we support the Ukrainian people in their efforts. However, I do think in terms of issues that are priority around what we say the kitchen table, I don't necessarily think that the issue of Russia's invasion of Ukraine is number one anymore. I think much more so now, American consumers, families, individuals, businesses are much more focused on the economy. And frankly, from a consumer and individual standpoint, it is about that cost of life and cost of living if you think about gas prices and grocery prices. So I think going forward for this midterm election that we're going to see, that those issues, not Ukraine, will be more dominant.
And of course, it's those energy questions around higher prices, of course, whether it's oil or gas, not just feeding into the impact on households, but also part of the geopolitics and part of what we're seeing in terms of the attempts by central banks, the Fed, of course, to raise rates. Let's get there then in terms of what is happening. Second half, throw forward to the second half of this year in this higher rates environment, lower liquidity across the globe. What is M&A looking like? Which regions, which sectors most active? Is it starting to ebb?
Well, at Moelis & Company, what we see with our clients, there's a lot of desire for dialogue around deals. There's no question about it. The thing that has occurred, though, over the last several months is the visibility toward completion has been somewhat diminished. And I think that is to be expected as we have all the uncertainty and clients are trying to navigate the prospects of continued inflation, the rise in interest rates, all the geopolitical concerns. So things are just taking longer. But I think our view from an M&A standpoint is, as you've seen the public markets essentially shut down in terms of the IPO market and the SPAC market, M&A becomes a real option for exit for many companies. And so we deal a lot, as you know, in the world of the financial sponsors. They have a lot of capital. They definitely are being more savvy and cautious in these uncertain times, but their mandate is to transact. And so we see with all of the change that's occurring, all of these sort of crises that people are facing, that long term that bodes well for the M&A market.
And what are you seeing? Valuations tie into that. What are you seeing in terms of valuations?
Well, no question that we are trying to reach equilibrium, if you will, in terms of valuations in the private markets. As we know, the public markets have certainly, the valuations have come down. And that's all sort of some of the dynamic that is playing out in the minds of our clients at Moelis. But again, I think we take the view that with these times of change, adding to that technological disruption, which has not stopped, despite the valuations in the tech arena and the public markets, that will even spur strategics to want to think about where they want to position for the next 5 to 10 years. Ultimately, that will require them to transact.
Where are you seeing the most activity? In which sectors? Can you kind of unpack for us where that activity is most pronounced?
Well, for sure. I mean, obviously, in the energy sector, there's a lot of interest right now, which has been a real turnaround in terms of investor desire to even consider.
Is that interest back into carbon, or is it aligned with ESG? Because we're seeing ESG under pressure as well.
Well, no, I would say in the U.S. there's a lot of interest in the private markets for sure to go back into some transition mode, which means natural gas. And part of the issue has been, back to my prior statements, that the signals from the government have been, we don't want to see any long-term investment in fossil fuels past 10 years, which, again, is stymieing the ability for us to do what we need to do to bring down fuel costs for the American people and, frankly, for global consumers. So I do think that sector, for sure. Information services, we're sitting here at Bloomberg. I mean, that's certainly a sector that continues to develop and to accelerate. I mean, all sectors have had some impact given the macro environment, but I do think longer term, healthcare, there are other business services sector that our bankers at Moelis are very busy in terms of dialogue with clients.
Okay, Eric, we can't let you go without another question on politics, given your storied history and experience within the political realm of the United States. If the GOP win in 2024, if you have a Republican president back in the White House from 2024, would you consider a position if they reached out, you tapped you on the shoulder, Eric?
Tom, I've lived long enough and had a long political career, and now one with Moelis, that I've learned to never say never. But I'm very, very privileged to be where I am. I'm enjoying the ability to see the world in terms of a financial lens and the ability for us globally to continue to help businesses to grow. And that's really where my lens was when I was in politics. I was a small business person and I always believed very much in innovation and creating a platform for investors to create wealth, to create jobs.
You push for the Jobs Act. We know about that. That sounds like you're keeping the window open, you're keeping the door open. And I'm going to have you down as Treasury Secretary in that Republican administration. You wouldn't push back on that, I'm assuming.
So listen, I think there are a lot brighter people than I that probably would be first up for that job. But again, never say never in life.
There you go. Humility as well. Eric Cantor, thank you so much. Great analysis, great insights into what's happening, of course, within the domestic politics of the US, the geopolitics, and, of course, M&A with Moelis. Eric Cantor, Vice Chairman of the investment bank that is Moelis and former, of course, US House Majority Leader. Thank you for joining us on set. Coming up, Ukraine takes one step closer to becoming a member of the European Union. We've got more on that story next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot
every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, European Union leaders are gathering in Brussels, where later today they are expected to grant candidate status to Ukraine and Moldova. The bloc will also discuss measures to combat the impact of Moscow's reduction of gas supplies to Western Europe. Germany's economy minister, Robert Habeck, called it an economic attack. And moments ago, Habeck triggered phase 2 of Berlin's emergency energy plan, putting the country one step closer to rationing, yes, rationing of gas supplies. For more, we are joined by Bloomberg's Europe correspondent Maria Tadeo. Maria, Germany really now sounding the alarm bells on this issue. Robert Habeck saying that he wants Europe to help with LNG deliveries. Will he get it?
Well, Tom, we're about to wait and see, but that language coming now from the economy minister in Germany now really sounding very, very concerned. And Tom, it really reflects some of the chatter here behind the scenes in the summit today. Real concerns are Russia, which, as you know, has been majorly reducing and limiting some of the gas supply to countries like Germany and Italy in the past 2 weeks, could really turn on the heat by potentially at one point cut it all together. And of course, the timing of this is particularly dangerous for Europe because storage is not full yet, and we're approaching what is the summer, of course, but this is all in preparation and with the view of winter. That is the most vulnerable time of the year for the European economy. A lot of them, of course, very dependent still on Russian gas. So this is a moment of a lot of concern here, a lot of worries about the implication for the European economy. And really, when you ask what is the solution, what is the plan, the issue here is that for the time being, they don't have one. So really, what a perfect storm is about to hit Europe.
There we go, the perfect storm. And of course, all of this linked to what is happening in Ukraine. And you could be seeing then an historic decision when it comes to Ukraine's candidacy for the EU, Maria.
Yeah, and Tom, this is now seen almost as a given, a done deal. All we're waiting for is now the formal confirmation of this candidacy status for Ukraine. This is clearly a political victory for President Zelensky. He said he wanted this. Ukraine campaigned on this for years, by the way, and this is a boost of morale for the country. But of course, we have to remind everyone watching this that this is a very long period. There's a big difference between being a candidate country to the EU and being a member of the European Union. And as you know, some countries get stuck in between for years. So over the short term, it is a win for Ukraine. But of course, on the longer period, it comes with a lot of challenges for the country.
Okay, Bloomberg's Maria today on the ground watching, of course, as officials there meet to discuss that candidacy application by Ukraine. Historic, as Maria has outlined for us. And of course, the challenge and the rewriting of the energy complex across Europe. Germany taking that step to phase 2. Rationing now is potentially a prospect for the largest economy in Europe, which is quite remarkable when it comes to gas. In terms of the markets, you're seeing losses now of 1%. Still significant moves into German bonds. 19 basis point move. Look at that on German 10-year, now at 144 after that weaker than expected PMI and services data at the Eurozone. Plenty more coming up. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kayleigh Lyons in New York, Anna Edwards, of course, in London. Stay with us. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
For the last few years, the fundamentals have mattered less than things like momentum and investor enthusiasm.
I would say we have a 50% likelihood of a recession globally, but also in Europe.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data.
They're definitely going for a soft landing. It's going to be almost impossible for them to pull it off.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 23rd. Our top stories today. Fed Chair Jerome Powell tells Congress that interest rate hikes could push the U.S. into recession, and a soft landing is very challenging. He'll testify in front of lawmakers once again today. The price of oil is falling again today as concerns over a slowdown increase. West Texas Intermediate is now down more than 15% in a little more than 2 weeks. Ukraine starts on the road to membership of the European Union. EU leaders meeting in Brussels plan to grant the country candidate status. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And you can't move for mentions of the R word, recession, Kaylee, something that seems to be moving the markets at this time.
Yeah, it is recession fears that are so dominant in this market right now, Anna, and that was just reinforced by the commentary out of Jerome Powell on Capitol Hill yesterday. He says he doesn't think it's overly likely right now, but he can't rule it out. So that is something that the markets are grappling with. Certainly that was the case in Asia, though overall it was a more positive session. The MSCI Asia Pacific Index was up just a couple tenths of 1%, but you actually saw outperformance coming from China after Xi Jinping in remarks overnight talked about that 5.5% GDP growth target, reinforcing it, saying that China is going to have policies that support growth. So that gave a little bit of a sentiment lift there. And in Hong Kong, the sentiment lift came from the incoming chief executive, John Lee, saying that he's going to look at easing border controls. So that lifted stocks there by about 1.25%. Broadly, though, those recession fears really are at the forefront, and you see that reflected in the bid for safe haven assets, or at least perceived safe havens. That in yields coming lower really across the world, including in Australia, where the 10-year was down 13 basis points to just about 3.85%. And then the only currency stronger against the dollar today is the Japanese yen. A second day of strength coming off of the weakest level since 1998. Right now, dollar yen trading at 135.46.
Right at the weakest level that we saw in 1998. Kaylee, the perceived safety of government debt, that's what we see investors looking for today in the U.S. 10-year. That's why we see yields right now at 309.63. Think about the fact that this is 40 basis points lower than we were just 2 weeks ago. We touched 350 in an intraday session. So the concerns are definitely about the R word, Anna, definitely about a recession. We only see S&P futures off about 0.1%. I thought it was really interesting this morning on Bloomberg Radio hearing you talk to George Buckley of Nomura. His bank thinks that we're going to see 5 consecutive quarters of contraction. That would be very bad news, obviously, for the economy and, of course, for oil demand as well. As a result, oil is down 2.33%, not just as a result of George Buckley's forecast, but just in general, the recession concerns around the globe. And then Bitcoin, normally acting, of course, in unison with S&P futures, normally very correlated with risk assets. But today, it's up 3.5%. Keep in mind, this is just the trade from midnight, and we're still holding at that sort of big round number at 20,000 right now, $20,575. Anna, what do you see in terms of Europe?
Yeah, we see that same risk aversion here then in markets, not as you were indicating in Bitcoin, but certainly in some of the other assets you went through. That search for the perceived haven of government debt, that continues to be the case here in Europe as well. So equity markets are weaker, down by 0.9% on the CAC Iran, down more than 1% on the Xetra DAX. And this is almost across all sectors, and basic resources right at the heart of things. So that is one of the weakest performing sectors across Europe. And copper is continuing to get weaker from here. So we've seen a lot of weakness creeping into copper over recent weeks, and that has intensified as we've seen more mentions of recession. It seemed to be focused on Chinese growth concerns previously, and now morphing into a more global concern, in particular around the US, and also concern about energy transition, and maybe that weighs on copper as well, if that is to be delayed in any sense. These two assets both responding to the same story, and this is about the PMI story and how quickly that PMI, that measure of the economy in Europe, how quickly that is declining from here. We got PMIs out of Germany and out of France, and both of those came in, yes, indicating those economies are still growing, but they were rapidly declining, and they came in weaker than had been expected, much weaker than had been expected. George Buckley and Matt mentioned from Nomura, pointing me towards the new orders number in Germany, saying that signifies an economy that is slowing very quickly. So we keep, of course, the euro in focus as a result. That's down by 0.7%. Money going into the perceived safety of government debt, and we see the 5-year yield responding, we see the 10-year yield responding, and we're seeing some quite sizable moves in today's session. I put in natural gas as well because we are still monitoring, Kaylee, what's going on in Germany. They've moved to this alarm stage of their gas management plan in relation to Russian input of gas into the German economy. The search is on for alternatives, of course, because everybody's mindful of what could happen with those Russian gas taps as we head towards the winter. So a lot to think about when it comes to the energy picture here in Europe. More on that shortly.
Yeah, absolutely. We'll have more on that in just a minute. First, though, we want to run you through the events in the day ahead, including the summit of EU leaders that starts in Brussels. Ukraine's candidacy status will be high on the agenda. The Federal Reserve will also release minutes of the results of its 2022 bank stress test. Then at 8:30 a.m. New York time, we'll be getting U.S. initial jobless claims and continuing claims. And finally, at 10 a.m. Eastern, day 2 of Jerome Powell testifying on the Hill, this time before lawmakers in the House Financial Services Committee, Matt.
All right, we will be watching that closely after yesterday, Jay Powell's most explicit acknowledgement yet that raising rates could lead to a recession. He told lawmakers that a recession is possible and achieving a soft landing will be very challenging.
It is our goal. It is going to be very challenging. It has been made significantly more challenging by the events of the last few months, thinking there of the war and commodities prices and further problems with supply chains. And the question of whether we're able to accomplish that is going to depend to some extent on factors that we don't control.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. to give us more of what we can expect from day 2 of Powell's testimony. Jack?
Well, first of all, you can tell that Powell is trying to thread a needle and acknowledge that there is a risk of a recession, but not say that it's inevitable, and make it clear that he has a difficult job ahead of him. That would be a major focus for members of both parties, I think, especially Republicans, trying to take the temperature on exactly how bad the situation is. One other interesting note from yesterday's hearing in the Senate that could transfer over to the House is a bit of pushback yesterday from Elizabeth Warren, trying to make the case from the progressive side that raising interest rates does not take care of the specific supply side challenges that have played into inflation so far. It doesn't specifically lower gas prices or lower grocery prices. The House Financial Services Committee has some high-profile progressives as well, including Alexandria Ocasio-Cortez and Rashida Tlaib, a wide range of Democrats from them all the way over to Josh Gottheimer. So if there's some pushback from the progressive side along the lines of what we heard from Warren, that would be a major takeaway from today's hearing, and we'll kind of suss out the differing positions that Democrats have on whether they really want to push Powell on those interest rates.
And of course, we also heard some Democrats really pushing the corporate greed narrative when it comes to the reason for higher oil prices. And of course, President Biden yesterday tried to address that, calling on Congress to suspend the federal gasoline tax for 90 days. It's obviously largely a symbolic move, but just take a listen to what the president said yesterday.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18-cent reduction, to the consumers. There's no time now for profiteering.
So, Jack, clearly this is a president that is running out of options as to how to address higher prices at the pump. Is this even a real option? Does this go anywhere in Congress?
The initial response to that was not particularly positive. Obviously, a lot of skepticism from Republicans, but even some key Democrats. There was a statement from Speaker Pelosi that essentially was a non-endorsement and kind of sidestepped the issue. But most interestingly, I thought, was Peter DeFazio, the chairman of the Transportation and Infrastructure Committee, who pointed out that this would ultimately take money away from the Highway Trust Fund. Lawmakers and President Biden tried so hard for that infrastructure bill that they got passed into law, and the idea that this would do more for individual consumers than it would to take away money from infrastructure projects is something that DeFazio and some other key Democrats may be skeptical of. So you're already seeing some pushback from Democrats who are allies of President Biden, let alone Republicans. So for now, there may be some support, especially from moderates who want to be seen doing something ahead of the midterms, but it doesn't exactly have a glide path forward, probably in either chamber.
All right, Jack Fitzpatrick of Bloomberg Government in D.C. And of course, we know that the price of oil doesn't purely determine the prices at the pump, and yet maybe some relief could be coming down the road as oil is resuming declines today amid increasing recession fears. Let's get more with Bloomberg's Danny Berger. So, Danny, it seems that the narrative firmly has moved to fears around supply to now fears around demand.
It's amazing how we just seem to be oscillating between these extremes, Kaylee. That's right. It's no longer unabated inflation. It's now unabated recession. And you can look at what oil's done, falling some 11% since Friday. That's a pretty extreme move, given that the oil market is still very tight. We are still in an extreme, a super backwardation for this market. So it just shows how much of recession fears are filtering through the market. And there's really not a clear consensus on where oil goes from here. Goldman says, look, demand still outstrips supply because of that tightness in the market. The Fed, they can't print commodities. Cities say they expect oil to keep moving lower. But to be clear, it's not just oil. It is commodities across the board. And I know you flagged copper before at down 20% from its highs. And I have a chart. It's the classic kind of Dr. Copper chart that does show the gold to copper ratio. That symbolic move of what's happening in the economy is at its lowest since early 2021. So it does suggest that this move higher in yields, the move pricing in inflation, is starting to turn. Perhaps that has peaked out.
Yeah, and let me get to something else that's giving us a bit of a gloomy sentiment check on the global economy, and that's here in Europe. We've had the latest European PMI data, Danny, which paints a picture of economies slowing pretty quickly.
Yeah, 16-month low for that data coming in. S&P's global economist pointing out that the German economy, the German numbers, essentially losing all the momentum that they had built up coming out of the worst of the pandemic. So yeah, it's not just inflation fears in the US, they are really acute in Europe right now after this data. BlackRock's Rupert Harrison saying odds are on for recession in Europe. And likewise, we have seen the dramatic move in this European bond market. 10-year German bond yields, those on course to see their biggest drop since March. France also seeing a drop of 18 basis points as well. So it is a big push into bonds. And of course, the euro also reflecting that economic weakness. That is down about 0.6%, Matt.
All right, Danny, thanks very much. Danny Berger there talking to us about what's going on with European PMIs as well as oil and the energy picture. We'll stick with that right now because Germany elevated the risk level in its national gas emergency plan, raising it to the second highest alarm phase following steep cuts in supplies from Russia. Maria Tadeo, Bloomberg Europe correspondent, joins us now from Brussels for more. Maria?
Yes, Matt, very serious situation for Germany now. And the language coming out of the German economy minister, Mr. Habeck, today now sounding very concerned about possible supply issues when it comes to Russian gas. And Matt, the timing of this is no surprise because we've seen that Russia over the past 2 weeks has been limiting the number of supply or the amount of supply into countries like Germany and Italy. There is now a real concern that this is going to continue ahead of the winter months or that Russia could potentially cut it at one point altogether. Now, this is a time of the year in which European countries, of course, start to prep their storage for the winter. The winter is a time of the year in which European economies are incredibly vulnerable to any issues with Russian gas, some of them depending almost entirely on this. And it does show that for the European economy, this is a very serious situation. When you ask, and I've asked this repeatedly today, what is the plan if that was supposed to happen or if that were to happen? They don't have an answer for it. So this is really a perfect storm that's about to hit this economy.
Yeah, so do we get one step closer to rationing of gas supplies in Europe? Maria, you're gathered there, well, the international media we see gathered there for an EU leaders summit. This no doubt will get a mention, but also accession talks around Ukraine.
Yeah, and Anna, today European leaders are expected to give candidate status to the European Union to Ukraine. It is a political victory for President Zelensky. They had been campaigning for this for a long time. It's in their constitution, the fact that they want to one day join the European Union. I should note, however, for our international audience that there's a big difference between being a candidate to join the European Union and an actual member of the EU. Sometimes that transition can take years, but nonetheless, it is a boost of morale for Ukraine. It doesn't mean they're joining overnight, but nonetheless, as I say, it is a political victory for Ukraine as the war against Russia continues.
All right, Bloomberg's Maria Tadeo reporting from Brussels. Thank you so much. Now to another story that caught our eye this morning. Elon Musk said Tesla's new plants in Germany and Texas are losing billions of dollars as the company tries to ramp up production. Musk said in a video discussion filmed on May 31st that both the Berlin and Austin factories are, quote, gigantic money furnaces right now, offering insight into Tesla's operations in the days leading up to Musk's decision to cut costs by laying off employees. As for how that is translating into Tesla's stock in early hours, not too much reaction. The stock is actually higher by a little less than 1%. Another stock moving higher is Snowflake. The software company was raised to overweight over at JP Morgan. The analyst putting a $165 price target on the stock. Right now, it's trading around $132, up the better part of 4%. Finally, we were talking with Danny about the declines we are seeing in oil prices. No surprise that is weighing on big energy players in early hours, one of them being Chevron, which is down about 1.4% before the bell, Anna.
Things to watch then, Kaylee. When we come back, we will talk to Marilyn Watson, BlackRock's head of global fundamental fixed income strategy. Does she think that yields have peaked for this summer, for this year even, as recession fears maybe put a lid on those. And on crypto, we'll talk to Adam Dell, Domain Money's CEO. He's founded many businesses over the years. What excites him about crypto right now? Plus, Binance CEO CZ is following a path popular among tech disruptors. Ignore the demands of governments for as long as possible. Read more on today's Big Take story, Bloomberg.com, or by typing NI Big Take into your terminal. That's where you'll find it. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller in New York with Kayleigh Lyons, Anna Edwards with us out of London. Now, I've been looking at a longer-term chart of oil because yesterday Jerome Powell and President Biden were blaming Putin for the rise in prices at the pump. So I thought, is that really the cause? Oil pre-pandemic was around $60 a barrel. And of course, it came down in the midst of the pandemic. Then we passed out $5 trillion to the American people, and it shot up to 90. That's a 50% increase before Vladimir Putin invaded Ukraine. Now it's at 103, so it's risen another 13, 14, 15% from then. But Eddie Vanderwalt joins us right now from Bloomberg Markets Live to talk about this. Eddie, I realize it's easy politically to blame Putin, but it could have been the fiscal stimulus that started the inflation issue.
Yeah, I would definitely look a lot closer to home if I was the Biden administration. I think, you know, there's two issues that came about well before the war in Ukraine. One of them, of course, OPEC supply cuts. OPEC had a significant impact on the market, but far more significantly, we did not see shale production pick up. Right, when prices started to pick up. Last time prices were as high as they are. Now, you know, the Baker Hughes oil rig index was sitting significantly higher than it is now. And the reason for that is they are worried politically. You know, U.S. shale oil producers are worried that politically it's unpalatable, and when prices come down again, they will be forced to pay higher taxes and all of these things. So they're not willing to make those long-term commitments to producing that you need to have a stable oil industry.
Yes, they've often called for a more stable investments environment, haven't they, Eddie? And no doubt some of that around shale drilling and also refining capacity will be in conversation today when it comes to that meeting between oil executives and the White House. Eddie, let me stick with commodities, but ask you about other commodities in focus. I mean, we were talking about iron ore just a day or so ago. We've been talking about copper this morning. It seems everywhere you look in commodities, there's another commodity that's losing faith in global growth.
Yeah, absolutely. Copper is another one. I think what we're seeing broadly is that investors are worried about a recession, but at the same time, I think there's a little bit of basket selling of commodities. We had macro investors getting really behind the commodity rally, and now they're starting to question that. So we're seeing some of that macro money pulling out of the space, and therefore we're seeing broad space, everything in the BCom, just pulling back a little bit, with copper and oil, the biggest targets.
Eddie, thanks so much. Eddie van der Veld of the Bloomberg Markets Live team. Thank you very much for your thoughts on oil, copper and beyond. If you want more market analysis, check out MLIV Go. That is the function for the Markets Live blog on your terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
now, keeping you up to date with news from around the world. Here's the first word. Rescue teams are struggling to reach survivors of a deadly earthquake that hit the remote southeastern region of Afghanistan. At least 1,000 people were killed and hundreds more injured. The Taliban has urged international aid agencies to help. In the UK, a nationwide rail strike resumed today. The Transport Workers Union says talks broke down on Wednesday. It wants higher pay and a guarantee of no compulsory job cuts. Tuesday's walkouts led to a roughly 80% cutback in rail service. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell tells Congress that interest rate hikes could push the U.S. into recession, and a soft landing is very challenging. He'll testify in front of lawmakers again today. The price of oil is falling again today as concerns over a slowdown increase. West Texas Intermediate is now down more than 15% in a little more than 2 weeks. And Ukraine starts on the road to membership of the European Union. EU leaders meeting in Brussels plan to grant the country candidate status. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And European stocks really feeling the pain of day after day, reflecting on the possibility of US recession, Matt.
Well, we're not anymore, Anna. I was actually kind of freaking out this morning listening to you on Bloomberg Radio, talking with George Buckley at Nomura.
I'm sorry for that.
He's saying, we could see 5 consecutive quarters of contraction. That's very bad, but futures are unchanged right now. In fact, you can see that they're just slightly in the green. So investors maybe not freaking out as much as me and George. I'm also looking at a 10-year yield that's come down a little right now, 310.38. Over the last couple of weeks, though, it's come down pretty significantly from a 350 intraday high down 40 basis points to 310. So investors are buying that debt. NYMEX crude is also off pretty significantly, down another 2%. So we're at 103.97. Call it 104 a barrel for Texas Intermediate. Obviously, Brent, the global benchmark, up a little bit higher. But the concern is that if we have a recession, there will be less demand. It's no longer a supply side issue. It's now turned to a demand issue for NYMEX. And then Bitcoin, right now it's up 3.25%. I will caution that this number is just from midnight last night. So it's pretty arbitrary since Bitcoin, of course, trades 24/7, 365. Right now, it's still hovering around that big round $20,000 level at 20,501. Kaylee, what do you see in terms of the pre-market movers?
Well, that move in Bitcoin may be arbitrary, but nonetheless, however Bitcoin is moving, that affects how crypto stocks are moving in pre-market trading. And they have all swung wildly with the swings in Bitcoin over recent days. Right now to the upside, Marathon Digital up about 3.7%. And for a stock like Coinbase, it was down 12% or up 12% on Tuesday, down 10% yesterday. Now in pre-market trading, it's up another 2.5% at the moment. But still, that's a stock that's lost about 3/4 of its value on a year-to-date basis. And of course, with the declines we were seeing in oil that Matt mentioned, you are seeing energy players under some pressure. Chevron and Exxon each down about 1.5%. And interestingly, Anna, I was looking at the sector performance within the S&P 500. Yes, energy is still far and away the best performer on a year-to-date basis, up something like 32%. In the month of June, it is the worst sector performer, down about 15% so far this month, Anna.
Yeah, and that takes us nicely into an update on what's going on here in Europe then, Kaylee. European stocks still under pressure. So as Matt was pointing out, we're managing to at least flirt with the flat line over on the US futures picture. But here in Europe, we seem to be a little more firmly entrenched in the negative and down 0.7% off lows, off earlier lows. That's the best I can offer if you're looking for some move higher here. This is the copper price. We've been talking a lot about oil. We've talked a lot about iron ore in recent days. And now we're talking about copper down by 1.9%. This is a continuation of a theme. There was a concern about Chinese growth. Now fears about a US recession and also the energy transition creeping into the conversation around copper as well. If there's any slowdown in that, and that may be debatable, but if there is, what does that do to copper demand? These two assets responding to the same thing, and this is concern about how quickly we're seeing slowing in the Eurozone economy. The PMIs today from France and from Germany, both pointing towards expansion, both still above 50, but they fell faster than anticipated, much weaker numbers than expected, and so the euro down by 0.6% against a dollar that, of course, is gaining ground because of that perceived haven status. And the German 5-year yield, I've got that in here as well. We're seeing demand for fixed income products of many varieties, and we see the yield then coming down by as much as 26 basis points on this particular 5-year contract then, Kaylee.
Yeah, these moves are really incredible in the European bond market. The 10-year German bond yield just 2 days ago was trading at 177. Now we're down to 143 this morning, raising a question as the market shifts back its focus more toward growth and recession fears. Have we seen the peak in yields? Joining us now is Marilyn Watson, Global Head of Fundamental Fixed Income Strategy at BlackRock. Marilyn, have we?
I don't think that we have seen the peak in yields so far. I think what we're seeing now is the market continuing to readjust to the flow of information and the flow of data that's coming through at a very, very rapid pace. I think in Europe in particular, they really have been hit hard by a number of factors, not least they're coming out of COVID at the start of this year. Then obviously the Ukraine-Russia war has had a massive impact on the price in the Eurozone in particular, in terms of food, energy. They've also been very impacted by the shutdowns due to COVID in China, and a whole range of different factors I think are really weighing on the Eurozone and the overall sentiment as well, and I think that's a very important factor.
Marilyn, good morning. So you don't think then that all the fears that you set out there, they're not significant enough to sort of cap yields where we've got to at this point?
I don't think so, not at the moment, because I think also on the other side of that, we're seeing inflation that's still incredibly high, and some of those factors that continue to drive inflation, of course. And then from the ECB, I think they very clearly signaled
that they intend to raise rates at the next meeting, about 25 basis points. They probably will, raise rates September, maybe December as well. I think the ECB also, with its emergency meeting last year, talking about some sort of anti-fragmentation tool. Yes. I think they're really doing everything they can to support the economy and support financial conditions as much as they can while continuing to normalize. So I don't think that we've necessarally seen the high yields.
Okay,
yet.
so you expect more rate hikes, and the market clearly expects more rate hikes on both sides of the Atlantic. I spoke to Stephen Major on an earlier program on Bloomberg TV this morning of HSBC. He's a famed bond bull, of course. Yeah. But he was saying that he doesn't think that that we will see central banks globally tighten as much as is priced in. I mean, we were talking in particular about the Fed. Yeah. You could ask about the ECB, whether when central banks start to see the damage being done to economies by either other factors or by their tightening, that they will step back and not tighten some more. So as if this isn't like Volcker, they won't tighten as much as the market is pricing in to fight inflation. What's your view?
So I think it's too early to tell on what the peak in the interest rates will be. I think at the moment, both the ECB and the Fed as well, and the Bank of England are all clearly signaling that they need to tackle inflation, and they really want to help to bring that down. But I do think at the moment, as we mentioned, we really need to watch the economic data. When you look at the US, actually, the economy remains pretty robust. I know that we're having all these talks of recession and other things, and we are seeing financial conditions tighten. We're seeing slowdown in the housing market and other things, but you're continuing to see, business investment. The labor market remains very tight. Consumption is so far relatively holding up, although as we would expect coming out of sort of the post-COVID environment, we are seeing a shift from consumption of goods maybe more to services. But I think at the moment, the central banks are really trying to address concerns in the market about inflation, and then maybe once they've tightened a little bit more, both the ECB and the Fed, then I think we'll be much more in a sort of watch and see mode when we look at the data.
Marilyn, what do you like in terms of fixed income? I look at the indexes on the Bloomberg and just see these incredible year-to-date losses. If you're going to go bottom fishing here, do you go into sovereigns? Do you like corporates? Do you like high yield? Do you like Europe? Do you like EM? What do you like?
Well, actually, I think that's the million-dollar question, and I think you've actually hit the nail on the head. And then when you look at the overall returns year-to-date in a range of different asset classes, they're quite poor. But then I think that does lead to actually we see a lot of value, and we see a lot of opportunities now within fixed income. What we're seeing also is a dispersion. So when you actually look at it on a bottom-up perspective, we do like some sovereigns. We also do like some, investment grade and high yield corporates. When you look at the investment grade space, for example, I think in terms of carry to vol, we now see some very enticing opportunities, particularly at the front end of the curve. I think that we're finding a lot there in terms of carry and a risk reward scenario. I think also, but it's really about being really very conscious of the environment that we're in and now looking at it from a bottom-up perspective. So in terms of alpha, I actually think we're looking at a very, very enticing opportunity set over the next 6 months and going forwards, because now we have seen this decompression in spreads. We're seeing much more dispersion in terms of different fundamentals of sovereigns and also corporates as well. So I actually think in this environment, for active investors, we're really, seeing some very good opportunities.
You mentioned carry. It makes me automatically think of the Bank of Japan. Can you fund everything by going short JGBs? I mean, are they just making it too easy, Marilyn?
I don't know that they're making it too easy, and I think that to fund everything, that route might be a little bit risky. We do at the moment have a small short duration position in JGBs, but I think we're also short duration in Germany at the moment and in the UK as well. So there are a lot of different funding scenarios, and when you look at the Bank of Japan, they are obviously one of the last men standing in terms of central banks. We've seen the SMB move as well now. And I think, looking forward over the next 6 months, it will be very important to see what the Bank of Japan do. And if they do eventually change their yield curve control approach and they do change their policy, that's also going to have a significant impact on flows into everything from treasuries to investment grade. That the Japanese investors so far are trying to get yield outside of Japan.
Marilyn, thanks very much. Thanks for your time. Marilyn Watson of BlackRock here with us here in the London studio. A little bit of breaking news just coming through. Some red headlines across the Bloomberg tell me that Russia says it has paid coupons on the 2027 and 2047 Euro bonds in rubles. It will make the Eurobond payments in rubles under the new scheme. This according to Russia, the Russian Finance Ministry putting out this statement today, and Russia saying it regards its coupon payment obligations as fulfilled. Coming up on the program, we will get back to the crypto conversation. Adam Dell, Domain Money's CEO. What does the crypto winter mean to him? This is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Well, crypto stocks are rebounding alongside Bitcoin this morning as it hovers around $20,000. Joining us now is Adam Dell, Domain Money CEO. Adam, of course, left Marcus, the digital bank of Goldman Sachs, to start Domain Money. It has a number of crypto funds. Adam, what kind of questions are your investors in these funds asking you right now amid this crypto winter?
Yeah, we have a lot of customers who are obviously suffering through a very difficult market where volatility is impacting investors who are really in crypto for the short term. Our longer term investors understand the volatility in this market and appreciate that this asset class is quite nascent, and so volatility is to be expected.
So talk to us first about what you do at Domain Money. I mean, I think we're all pretty clear on Marcus, and you have founded a number of other businesses before you went to Goldman Sachs. What's Domain Money do?
Domain offers managed portfolios of different asset classes. We offer stock portfolios, we offer crypto portfolios, and we manage those on behalf of our customers.
So in terms of crypto, I always wonder what the institutional uptake is like. Are your investors mostly retail? Are you getting a lot of institutional interest? Have you seen a change in that?
Our investors are retail investors. We don't really serve the institutional market today.
What about institutional interest in, I mean, you're obviously in and around Wall Street. What do you think about the institutional interest? Is it going to stay amidst these huge drops that we've seen?
Yeah, I mean, the flow of funds into the digital asset class, has certainly taken a hit given the overall market environment. But institutional investors are absolutely moving into digital assets. If you look at the performance of, say, Bitcoin, for example, over the last 2 years, it's basically up more than 100% from July of 2020. If you compare that to, say, the Wisdom Tree Cloud ETF, which is down from $39 2 years ago to about $29 today, you can appreciate that while this asset class has taken a hit, particularly Bitcoin, there's some resiliency in the price of Bitcoin, which is really a proxy for the overall sentiment for the blockchain and crypto ecosystem.
Good to speak to you, Adam. Good morning. For institutional investors, what kind of question do you think they should be asking? Should they be asking which crypto asset is going to do best over a certain time horizon? Or should they be asking which industries are going to be transformed by the blockchain? What excites you the most?
Yeah, Anna, that's a great question and point. I mean, the reality is that, the blockchain ecosystem is made up of a collection of engineers that is really about 25,000 developers. If you compare that to, say, the Java developer community, which has about 7 million developers, you really get a picture for how early these technologies are. And because blockchains enable people to speculate, even at the earliest stages of projects, you see enormous inflows into the ecosystem, particularly during the period of real euphoria 8-10 months ago. And so, what we look at Domain is the core engineering efforts that are being built around useful things in our banking system: exchanges, settlement, audit, taxation. Those pieces are very, very early in terms of being built out by engineers. And so when we look at investment opportunities in this space, what we're looking at is software engineers building real valuable technologies that have a useful function in our economy.
Have a useful function in our economy, and maybe that takes on some of the critics who ask what is the utility sometimes of all of this. So you point to banking as an area that could be transformed by blockchain, Adam. Other sectors, are there other sectors that you think will really be transformed by this technology, taking a longer term view?
Yeah, well, certainly gaming is being transformed by blockchains. NFTs are an on-ramp for many consumers to use these technologies really for the first time. Most consumers really can't get their hands around assets like Polygon or Ethereum, but they do understand what an NFT is. And so that on-ramp into these technologies is really most being felt in the gaming world. This week in New York, it's NFT week in NYC. And what you see is a very vibrant community of people who really don't care what the price of Bitcoin is, but are interested in NFTs, interested in the technologies that allow participants in games to live anywhere, participate anywhere, and really define how games evolve, because it is a community-led effort to generate gaming activity rather than a centralized activity by an individual gaming developer company.
Adam, I'm fascinated by smart contracts and the idea, Mayor Eric Adams has said we could have birth certificates and property deeds and so many more important documents on the blockchain to cement that ownership or that validity. And then I wonder about proof of stake versus proof of work. I don't want to get too far into the weeds, but I have to say I'm skeptical as a journalist and as an enthusiast about proof of stake. How do you feel about these two systems of maintaining the blockchain?
Yeah, I mean, proof of stake is certainly a more energy efficient and scalable approach to consensus. And so it's very likely the future of how blockchains evolve. proof of work consumes a fair bit of energy, isn't necessary to ensure validity and security. Now, while these technologies are nascent, nobody's found a more secure way to build a distributed ledger than a blockchain. What I'm encouraged by is if you go out into the developer community, the engineering community, startup community, and you look for teams that are working on, banking systems, distributed ledgers, gaming systems that are next generation, you'd be hard pressed to find an engineering team that isn't doing it on top of a blockchain. And that really tells you something, because it is the engineering effort that leads our technology forward, and they have voted with their feet.
Adam, great to get your take. Thanks so much for joining us this morning. Adam Dell there, the CEO of Domain Money, talking to us about the crypto universe. For more on the world of decentralized finance, the blockchain, and cryptocurrencies, tune into Bloomberg Crypto. It's Tuesdays at 1 p.m. New York time. Next week, we're going to speak with Troy Gajewski, Chief Market Strategist at FS Investments, as well as Mary Catherine Lader, the former BlackRock rising star who defected to the DeFi industry. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And Tom, it seems that data out of the Eurozone adding to the sense that we find haven, or we seek haven in bond markets, and stocks have been selling off. That's been the story here in Europe anyway. I know you're also focused in Europe. You're thinking about inflation here.
I'm thinking about inflation as the overarching issue and the cultural aspects of inflation. I'm only doing this, Anna, for Matt Miller. I mean, he's so shocked shocked by where BitDog is. We got to give him some love on his Germany. This is German inflation far back before the joining of East and West Germany. This is well back into the 1950s. And the massive success of the early 50s, 60s of Konrad Adenauer of controlling inflation off of World War II up to the shocks of an ascendant Deutsche Mark and inflation that was high, but not nearly as high as what Paul Volcker had to deal with in the late 70s in America, and then on down, Matt Miller, to the massive success of German disinflation for well over 10 years, and up we go, and the upper circle is where we are right now, just under 8%. That's unacceptable.
Yeah, it'll be so fascinating to see if Powell later is compared to Volcker, Moore, or Arthur Burns. Stephen Major this morning saying he thinks it's only going to be a couple of months. By the way, Tom, I used to go to meet with Dan Briette when he was in Berlin begging the Germans to take our LNG instead of using Russian gas. Now Amos Hochstein, I guess, will be part of the crew going to the Middle East to ask the Emirates and the Saudis to produce more?
Boy, have things changed. That's all there is to it. Price matters, and when price of hydrocarbons goes up, and particularly in Europe, where they call it the natural gas war off the war of Ukraine, there's a whole new dialogue. And we're learning about this every day, Matt, and very importantly, this is tentative, but very much scheduled in surveillance this morning. Maria Tadeo in conversation with the president of Lithuania, without question, our most important conversation of the day.
All right, Tom, thanks very much. Tom Keene there, co-anchor of Bloomberg Surveillance. He'll be coming to you next with Lisa Abramowitz and Kaylee Lines. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
volatility is part of the global deal at the moment.
We're about 2/3 of the way there in terms of your average bear market.
We see the weaker links, the most vulnerable, have gone down the most.
The market's really worried about recession fears. 50% chance priced in across U.S. and other countries.
What seems to be priced in right now is a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on radio, on television. Claims at 8:30. We'll do that, but much, much more to talk about. And Lisa, we've simply got to look at the bid on the markets 2 days in a row. Is this possibly a lift off the bottom?
The odd thing is, we heard from Jay Powell yesterday. He had a pretty gloomy tone, saying, yes, they can possibly avoid recession, but that it is a distinct possibility. And here we see not only are stocks having a bit of a bid into them, but so are bonds. You're seeing bond yields down for yet another day, a sharp rally, even on the front end. What does this mean in terms of expectations for the Fed and how far they'll have to go?
Off commodities, as mentioned by oil, Lisa. Amrita Sen to join us later. Thrilled about that with her great work on supply and demand dynamics of oil. I got Brent Crude at a 110 level. We almost got to 99 on West Texas Intermediate.
Is oil finally responding to the recession fears?
Demand destruction.
Demand destruction, exactly. Yeah. Is this what we're seeing in markets? And if so, how far can it go given some of the tightness in the market that we've seen? RBC came out with a note yesterday that I thought was fascinating, which you've got this commodity analyst asking traders, so is this it? Is this the oil market finally falling to recession fears? And the trader said, no, they've been pricing it on all that time, and that's the reason why you're not seeing $150 a barrel and simply a range of 100 to 120.
Focused on the Westminster Dog Show, the Bloodhound winning as well. Kaylee Lyons joins us this morning in for John Farrow on a well-deserved. I teared up at the Westminster Dog Show last night. Kaylee, I look at the trophy winners out there, and the winners right now have to be the bull crowd. There's this thundering silence of the gloom crew, isn't there?
I don't know if there's thundering silence because there's still plenty of people out there. I mean, we've heard from Mike Wilson, for example, talking about the 3,000 level on the S&P 500, and the R word, as people are now referring to recession, is still very abundant in conversation, Tom. So there's definitely a certain amount of gloom out there, even if you aren't necessarily seeing that reflected in risk assets this morning. I would argue you're definitely seeing it, though, in haven assets. Lisa was referring to how yields are coming in on treasury yields. Take a look at what's happening in Europe. The 10-year German Bund yield is down something like 20 basis points after those really quite awful PMIs, the worst in 16 months.
One more thought here. I'm going to do the data check in a moment. 3.01% on the 2-year yield, under 3% is a modest, big deal. Lisa, scheduled an important conversation for Bloomberg in this hour with the president of Lithuania. This is a critical conversation for the Baltic states.
Especially given the threat of Russia, especially given what's been going on with gas. We've seen Germany start to talk about possibly sanctioning or rationing gas in order to prepare for Russia curtailing some of those supplies. A really important conversation, as this does present some existential questions, certainly to Eastern Europe.
A data check right now. Let's do it with green on the screen. We were red 2 hours ago in the early morning. Futures up 11, Dow futures up fractionally as well. NASDAQ gives me 0.6% lift. The VIX critically under 30. Symbolic it is of a recovering market, 32 down to 29.17. Brent Crude 110.54. West Texas 105. I mentioned the 2-year yield, 3.01%. We're going to have to watch that for the breach of a 3 down to a 299 handle. 10-year yield 3.12%. Yields just simply coming in on the recession worries. Let me close out with DXY. 104.55. Euro can't get out of its way. 104 now with a slight recovery in the last 20 minutes off the ugly PMI data. And Kit Jukes, among others, watching sterling 122.11. Jukes suggesting 120 in the Boris Johnson future. We need to get briefed. It's a very brief because we're briefing on claims. Lisa.
Thank you so much, Tom. I guess I do want to just say one thing, though, about the bond rally. This idea that we're seeing even the front end rally, even as Jay Powell said he's going to hike into weakness. He is going to keep hiking to prevent inflation from getting unmoored in terms of expectations. And yet still people are expecting he won't have to go as far and fast as even he is saying. I find that really interesting. Today, we got U.S. initial jobless claims at 8:30 a.m. a.m.? How much do we get a sense of the labor market starting to soften even more? And then we get at 9:45 S&P Global U.S. June Manufacturing Services Composite, as well as a whole host of PMI data. This follows what we saw over in the Euro region. And Kaylee mentioned this. We saw PMIs over in Europe fall to the weakest in 16 months, going back to early 2021 in the face of some of these higher costs. And I think that it's important to watch whether you get the exact same kind of downside surprise in the United States. At 10 a.m., day 2 of Fed Chair Jay Powell on Capitol Hill, testifying this time to the House Financial Services panel. How does he respond to two-year yields coming down? Basically, the market is expecting less from him, even as he goes harsher and saying it is of utmost importance to get back to 2% inflation. And at 4:30 p.m., the Federal Reserve's board is going to be releasing stress tests for the banks. What are they going to look for in terms of stresses? We see year to date, the banks all down north of 20%, south of 20%. And how much can they return capital to shareholders after these stress tests? That's usually what these pave the way for, Tom.
Very good, Lisa. Thanks so much. I do want to note the two-year yield in the United States through 3% to a 2.99 earlier this morning. Right now, aware of that is Deepak Puri, Chief Investment Officer for the Americas at Deutsche Bank Institutional Private Bank, joining us here on the state of play. Deepak, I want to talk a little bit of calculus here, and that the media looks at inflation hot, and then they look at where inflation will be less hot. And yet you and I know it's a marginal story. Do we have a behavior now where we're beginning to discover that over the coming week or month or quarter, we will marginally have lower inflation, which will be optimistic for the bulls?
Good morning, Tom. Yes, I do believe that this is where, one of the things, the more narratives in the market is really panning out to be. You look at the 5-year break-even rates, for example, they are the lowest today they have been since the early part of this year. I think tomorrow's UMISH consumer sentiment, the final reading would be sort of a little bit enlightening on that aspect as well. 8.3 versus 8.6, yes, it's marginal, but I think what really took market by surprise was the uptick. And our expectation is going forward, you are going to see some moderation in that number. We are already seeing some of this demand destruction that you guys were talking about. I think overall, you're looking at a little bit of moderation, but still way above anyone's comfort level, especially the Fed's. Hence, inflation remains to be a key story in the market, especially, high level of inflation, and if it starts to accelerate even more. So overall, I think the market oscillates between inflation concerns to now, over the last couple of trading sessions, recession concerns, but none of these two themes are going to go away anytime soon.
Deepak, do you understand why the two-year yield is rallying? It's a really basic question, but it is boggling my mind right now.
Well, Lisa, I think the key narrative here is that maybe we're going to have a quick and mild recession, and by in the next year or so, the markets are already going to be focused on the next level of Fed policy action, which might be actually a bit more market-friendly and cutting rates. So we get to the what I would call the terminal rate fairly quickly, and then you hedge back into the neutral rate. So the restrictive Fed policy may not be, we might get there quicker, but it not be something that's quite sustainable for this market. Hence, we head back to the neutral number, which then creates this kind of a narrative. It's still too early to say by any measure of certainty that that's what's going to happen. Yeah. But at least the bond market is pricing in a much more, quicker and milder recession at this point. At least that's what I think.
Is it still too early to say that we've seen the peak in yields?
I think it's too early, Kaylee. I think you could still argue, we are not really out of the inflation story. I think the recession concerns have taken a little bit over the narrative for the time being, but the inflation can create, raise its ugly head anytime. I would not be quick to judge that we're out of the woods when it comes to inflation, and hence the market, especially the bond markets, really going up in yields. It might take a while. I think the recession fears, to my mind, creates another set of opportunities and risk. And something that I've been seeing from the clients is a bit more risk appetite. It's coming from very low levels indeed. There's nervousness, but there is no panic in the markets, at least the investors that I'm talking to. They're starting to get back into the markets, and that's a relatively a good sign. Another trend is really a home bias trend that we are seeing, where investors seems to be much more comfortable, taking risk in U.S.-based equity and bond markets.
Deepak, we have to leave it there. Deepak Puri, thank you so much, with Deutsche Bank International this morning. Lee says, Deepak mentions here the international domestic divide, whatever your domestic is tangible. I went through 3 Pacific Rim currencies today, Thailand, Philippines, and something else I can't remember. And, I'll be honest, they're just breaking out. They're leading a life of their own versus strong dollar, weak Thai baht.
I'm not laughing about the fact that they're weakening. I'm laughing at the fact that it was really notable that one other currency that whatever is also breaking out.
I mean,
it's the surveillance CFA level on this Thursday. Things are moving, and it is interesting at a time when you see, after years of trying to weaken currencies, it is now a bad thing. There was actually a Business Week story that caught my attention because it follows on to the conversation that we have been having, Tom, every day on surveillance for the past couple of months. Suddenly, the currency wars narrative has gotten flipped on its head. It is a race to a stronger currency so you don't import more inflation, and that has to be the story of 2022, Tom.
The story of this hour is we are prepared for a conversation with the president of Lithuania. We'll see if we get there. And Kaylee, the headlines come out from the press office of Mr. Putin. This is Mr. Peskov speaking here. Peace possible, but Ukraine must, quote, accept all demands.
Yeah, this is according to the IFX news agency. But of course, Tom, Ukraine has already indicated that there are certain demands of Russia's that they are not willing to accept. They don't want to cede any territory. Of course, it's interesting that these comments from the Kremlin come in light of the EU leaders meeting that is happening right now in Brussels, where they're going to talk about Ukraine joining potentially the EU as a member.
And by all reports, a brutal war in eastern Ukraine. Please stay with us through the morning on economics, finance, investment. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It was Fed Chair Jerome Powell's most explicit acknowledgement yet that raising interest rates could lead to a recession. Powell told lawmakers that a recession is possible and a soft landing is very challenging. But he said the other risk is that high inflation gets entrenched in the U.S. economy. Powell is back on Capitol Hill today. The price of oil resumed falling today. West Texas Intermediate dropped below $105 a barrel after closing at a 6-week low on Wednesday. The U.S. benchmark has lost more than 15% since the close on June the 8th as fears of a recession increase. And in China, President Xi Jinping reaffirmed a growth target that analysts say is out of reach. It was the first reference to the target since a Politburo meeting in April. China is expected to miss its GDP goal of around 5.5%. The government's zero-tolerance approach to fighting COVID and a weak housing market are the problems. In the UK, a nationwide rail strike resumed today. The Transport Workers Union says talks broke down Wednesday. The union wants higher pay and a guarantee of no compulsory job cuts. Tuesday's walkout led to a roughly 80% cutback in rail service. The chief of the school district police in Uvalde, Texas, has been put on leave in the wake of the mass shooting there. The state's top police official criticized Chief Pete Arredondo for delaying the confrontation with the gunman at the elementary school. State and federal officials are investigating the police response. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Do you agree with the perspective that if interest rates go too high, too fast, that it could drive us into a recession?
Certainly a possibility. It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months, around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
America, Jerome Powell answering a question there from the gentleman from Montana. Senator Tester knows what it's like to fill up the tank and drive next door like 200 miles, which is what they do in much of his state of Montana. There'll be further testimony, I believe, today. Right now, Lisa Abramowitz, Kaylee Lines in for John Farrow and myself here with markets green on the screen and nudging up. We've got to get to Jack Fitzpatrick on the festivities of Washington, but first, and I really want to frame this, Maria Tadeo with us with a bit of a history lesson on the importance of her discussion with the president of Lithuania in the next hour. And what this comes down to, Maria, is if you take A7 West out of Vilnius, you run into a thing called Kaliningrad, which is Konigsberg, which is a beer from my youth, and the Russians own a hunk of land, which is a port that doesn't freeze over in the winter. That's the bottom line, is it's a port that in the winter they can get their naval ships into.
Absolutely, Tom. And of course, this also gives Russia access to the Baltic Sea. And ultimately, that is what it comes down to. When you look on a map, and you really have to look at it on a map to really understand the importance of this place, Kaliningrad is very small, but is vital, and it is crucial for the Russians. It is squeezed between Poland, which, as we know, has a very tense relationship with Russia, a very complex history with the Russian Federation, and Lithuania. Now, the issue here, of course, is that the Russians are accusing the Lithuanian government of blocking access to Kaliningrad, and they say, don't stop doing that. We could see retaliation from the Russians. For Lithuania, this is now a real concern in terms of potential escalation that may come.
Help our American listeners and viewers, including a dummy like me. What are the distinctions between Estonia, Latvia, and Lithuania? Are they one and the same, or are they like the Swedes and the Norwegians where they barely talk to each other?
Look, Tom, I don't want to generalize on different countries and their different cultures, but I would say if there's something that the three Baltics that you alluded to really share is their dislike for Vladimir Putin. And of course, I'm being very polite using that word, because if you speak to them behind the scenes, they will use other type of language that I can't use on TV. But the thing that the three of them really share is this concern, this dislike, and of course a very, very difficult history with Russia. Remember, they were part of the USSR.
Lisa, did Maria finesse that? That was just magical.
She finessed that. And she can even pronounce Javier's last name. This issue over in Europe, we're dealing with the potential cutting off of the gas supplies from Russia into Germany, which has led to calls for possibly restricting certain types of energy usage. Jack, over in the United States, we heard yesterday about the possible removal of a gas tax, which was panned by both sides of the aisle. Is there further discussion about trying to restrict demand, to take some sort of stab at this on the other side?
There's not a lot of discussion in terms of legislation or anything that would restrict demand. There was pushback to the proposal by the president to do a 90-day gas tax holiday. The alternative, as we've seen that pushback that was mentioned by Chuck Schumer and many other Democrats, is something along the lines of a price gouging measure. But when it comes to restricting demand, really the conversation is much more broadly about fiscal policy, reducing the deficit, that kind of thing. There's not a lot that they're talking about to specifically reduce demand for gas, to target gas prices.
Jack, one thing I noticed in the hearings with Chairman Powell yesterday was that Democrats were trying to point the finger, as they have, at President Putin, at corporate greed. Senator Cortez Masto, the Democrat from Nevada, was talking about Glencore raking in billions of profits on trading on commodities. Is that a message that is resonating or landing with the American people? Do they buy that?
It doesn't seem to be making a huge difference in the big picture, especially as we look toward the midterms. The president's polling is down. The Democrats feel a lot of pressure to try to do something about gas prices and inflation more broadly. But that is clearly the line that the Democrats have settled on, as opposed to a gas tax holiday, is at least trying to spin this as an issue of corporate greed. That's easier for them to campaign on. It hasn't lent itself to a realistic proposal that would necessarily make a difference in the short term. But if they're trying to make a show that they're doing something, that there's activity there, the price gouging, corporate greed line, it seems to be the mainstream Democratic response as they feel the desperation to come up with something.
Jeff Fitzpatrick, thank you so much from Washington. And Maria Tadeo, who is scheduled to be with us within the hour, with the president of Lithuania. Lisa, I look at the screen here, equities, bonds, currencies, commodities, and I think the trap is to say it's uninteresting this morning. I don't buy it. There's some real interior dynamics to what we see.
I find this morning fascinating because I don't understand the short end bond rally. I understand why people are going into longer dated bonds. But in the near term, you've got two potential scenarios. Either the data comes in weaker than expected, the Fed does not have to hike as much, and we avoid the hard landing, right? That is not necessarily the very deep recession types of scenario that some people are putting out there, or people are just thinking that they're not going to have to raise rates as much. I don't understand why we're breaching 3% on a 2-year yield if people are expecting the Fed to follow through on the hawkish expectations, Tom.
And Kaylee, first signs of demand destruction. There's a chart floating around. It may be from Bloomberg. I can't remember. But the basic idea here of we are seeing fewer gallons of gasoline being pumped because of the behavior of consumers.
Yeah, does that affect the summer driving season? Do people decide not to just take those road trips anymore because the price at the pump is so high?
Who takes a road trip? I mean, I
love road
New
trips.
York.
I added a puppy to the family, Tom. Can't take the train or bus with a 75-pound beast.
Some people can drive, Tom. Just saying. Some people actually use their cars. I think it's a really good thing. And frankly, nobody that I know has actually stopped taking a road trip.
Well, there you go. Either way, Tom, the point of the story this morning is that the narrative for commodities, for oil in particular, has shifted from supply side, supply being constrained, now to real concerns about the demand picture and whether that destruction that you speak of is going to kick in a meaningful way.
We're going to do this on oil, folks, later. Amrita Sen will join us here. She is exquisite on the microeconomic supply and demand of hydrocarbons. And Lisa, that'll be a good update.
It's really important to understand why we're seeing weakness right now, and if it's just a pause or if it's something akin to what we hear from Ed Morse over at Citi.
If you are in Helsinki, you look across the pond at Estonia, down to Latvia, and then a very much larger Lithuania. In the Potsdam Conference of World War II, they gave a hunk of land to Russia called Kaliningrad. It is surrounded, and I mean surrounded, by Poland and Lithuania. Our Maria Tadeo with the president of Lithuania in this hour.
Everyone you meet in Port Harcourt has stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.